At the end of this video, you're going to learn everything that you need to know to become a consistently profitable trader, even if you're a complete beginner with no experience whatsoever, because what I'm about to teach you is the same thing that took me from broke, working a job that I absolutely hated, to making 20k a month consistently, living the life of my dreams, and it's the same thing that's worked for all these traders on screen now. So what you're about to learn in this video is a transferable skill set that you can start using today in the market, whatever market that you trade. Now, I've laid out the video step by step in a deliberate way, so make sure you watch the video from start to finish. It is a long video, so take a pause, spread it out for a few days, or make sure you watch it in that order, because I made it as easy and simple as possible. Everything that you need to know is condensed into just 2 hours. And as a bonus, you're going to get my personal trading strategy that I use in markets, and what all those traders that are becoming profitable that you just saw on screen also use. So make sure you enjoy the video and make sure you like and subscribe. Here we are on EURUSD, and here we are on the weekly chart. Now, the first thing I like to do when I'm studying daily bias and I'm studying these charts is I like to look for the overall trend, right? I want to look for the most recent trend in price action, right? So I don't care about this bit, I don't care about the choppiness here, right? Because remember, this is the weekly chart, so the emphasis is always on the most recent price action, right? I don't care what happened, in 2021, right? If this was like the 15-minute or 5-minute, I would, but this is the weekly chart, so I don't care about any of this. I don't care about any of this. I only care about the most recent pricing, and it's pretty obvious what price has done, right? Bullish, strong trend. Now, I'm going to show you right now, I'm going to compare this to a few different markets, and I'm going to show you how much we can learn from just this weekly chart, right? So this is euro dollar. Remember this chart, right? And remember this high and this strong aggressive move up, right? So here is GBP USD, right? Again, very similar. So let me just show you again. Very similar to Euro USD, where we've got this huge move off, and then GBP USD, right? Where we've also got this huge move off, right? Very, very similar. These weekly charts here are very similar. Now you might be wondering, okay, Atif, where am I going with this? What does this really mean? Now watch this. This is really, really important here. Let me just clear this off. This is really important here. So here's euro dollar, here's GBP USD. Let's go look at Australian dollar, right? So remember this high and this high here. Look at this, right? Look at this. This is so important right here, because this alone tells you so much. So here's the high on Australian dollar. Let's just get New Zealand dollar up too. Here's the key high that price does not take out, right? Like this. So we've got NZD USD, AUD USD, and then GBP USD. Can you see how price takes out this high right here, right? Now you might hear this be called SMT Divergence, or just divergence in general. The name does not matter, but this right here in price action is such a key clue on the weekly chart, right? This on the 5-minute or 1-hour chart does not matter, but on the weekly chart, this is smart money screaming at you. And what they're really saying here is, can you see how price took out this high on euro dollar? It does it on GBP USD. It does not do it on AUD USD, and it does not do it on NZD USD, right? What does this mean? Because everyone can spot divergence very easy, right? To pick, hey, it didn't take out this high, but what does this really mean? This is so important, right? So make sure you write this down. This right here is worth its weight in gold, right? And I'll explain why it is later on. I'll show it in gold too, right? Just so you know. What this means is that euro dollar, euro USD, is very strong. It's a very, very strong currency. Similarly, with GBP USD, it's also very, very strong, right? Whereas with AUD USD, it's a weak currency, right? It's a weak currency. Same thing with NZD USD, right? The fact that they couldn't take out this high is on the weekly chart, right? Not some random, 5-minute, 1-minute chart. On the weekly chart, it's smart money screaming at us that NZD USD is very weak. AUD USD is very weak too, whereas GBP and EU are both very bullish. Now, what does this mean? This means that you only look for longs in euro dollar and GBP USD, and you only look for shorts in AUD and NZD USD, right? Super important. Go rewind that, right? Make sure you only look for shorts in NZD and AUD, right? And only look for longs in GBP and euro, right? Now the reason is, and this is so important, and every trader, right? Everyone who's traded has had this, right? Where let's just imagine, let's just say you're bearish, right? There's some sort of bearish fair value gap. There could even be a liquidity sweep. So if you know what a liquidity sweep is, it's just a stop run. Some old high gets taken, price goes off. There's lots of fair value gaps. You enter into your trade, let's say at fair value gap, order block, Fibonacci, whatever you like, and then price just chops for ages, right? It just chops, it goes down a bit, and it comes up, and then maybe it just touches your stop loss and then just chops for ages, right? and price just consolidates. It does nothing, it just chops around, and it's so annoying. And the reason why this happens is because you go short in a very strong currency, right? You go short in a very strong currency, and this is what you get, right? So you never, ever, ever go short on a strong currency. You never, ever, ever do that, because that's what you're going to get. You're going to get choppy trades, and you're going to lose trades, right? You're going to have so many unnecessary losers, and that alone can take your win rate from 40% to 60%, right? And that right there can make you a millionaire very fast, right? You can make money very, very fast with just this little tip alone, right? This right here saved me so much money. It's insane. Okay, so the next thing we do, and can you just notice, right? Like, I mean, that took about 15 minutes, but can you see how right away we know that euro dollar GBP, very strong. Obviously, we want to short AUD. NZD, same thing with indices, same thing with gold. We've learned so much just by using the weekly chart, right? Like, we already know what we want to do. But what every trader needs to do, it doesn't matter whether you trade Bitcoin, indices, gold, especially if you trade gold or Forex, everyone needs to be looking at the dollar, right? If you're not looking at the dollar, you're blind, right? And it might sound harsh, but the reality is, the US is still, the number one economy in the world. What their market does will affect every single market in the world, right? And we'll talk about this later on, especially when we get into Forex, but dollar is seen, when the dollar starts to drop, gold will go up massively, right? People will move their money away from dollar into gold, right? Because gold is seen as the store value. But anyway, here we are on dollar, and most people use Dixie, and I use this for a long time, but instead what I've found is if you type in DX, you should get this, US dollar index futures. Now, don't worry, you don't have to pay for the data or anything. What it does is this shows you a lot more gaps in price action, and this is as close to the real price of dollar that we can get, right? So, and for those who don't know, the dollar index is just a dollar against all the major currencies. So it's essentially how strong or weak is a dollar, right? But anyway, here we are on the dollar, and like I said, first thing I like to do, what's the most recent trend, right? Clearly bearish, right? But where are we actually going to? So if you remember in one of the previous videos, I'm not sure which one it was, right? Price was, so can you see this gap right here? This is really important. This is actually a volume imbalance. So you can see my analysis here. Just remove this. This right here is a volume imbalance. This is like a super fair value gap. It's like a really strong fair value gap. So the gap, see how these wicks are covering each other, but there's no like bodies. Right, this gap here is a volume imbalance. Now I think there's loads of different names for it, so don't worry about the name. The name's not important at all, right? It's all about the logic. And I mean, look at this. I mean, almost beautiful, isn't it? It's beautiful how it fills the whole thing up. And if you remember in the last video, I think, not the last video, but a few videos ago, we were at this point in price action, right? We were at this point in price action. I did mention, right, not to brag, but I did mention that I think we were going to fill this entire volume balance because price loves to fill in these gaps. So anyway, what that just tells us is that price, or at least dollar, is bearish. So for me, I like to always have a target in mind for price action. I always like to see, okay, where could price realistically, sensibly go next? And my eyes instantly, and you will get this too with trading, right? See this? You see how we base? So this is the same thing here, right? We have a volume imbalance. We also have another little mess of a volume imbalance. It's almost like 3 candles forming it. But this right here is what I'm more interested in. This right here, right? So let's just zoom out of the chart. Zoom all the way out. Where are we now? So here we go. So this volume imbalance here is the next magnet for price, right? So it'll essentially pull price towards it, unless of course something crazy happens, or a war, whatever happens, right? And price shoots off in either direction. But this is our next logical target for price, right? So if the dollar, and this is really important, this is the most important part of the whole dollar analysis, right? If the dollar is bearish, what does that mean for euro dollar? And just look at this right here, right? We have euro against the US dollar. Most people trade Forex, they have no idea what Forex even is. You have the euro against the US dollar, 2 currencies pegged against each other. So what that means is, let's just think about it. If you've got the euro and dollar's weak, right? Like we can see right here in the charts, dollar is weak and dollar's dropping. What does that mean for euro dollar? Think about it. If the dollar's dropping, what does that mean for euro USD? Is it going to go up? Is it going to go down? Or is it going to do nothing? Right? It's going to go up. Right? It's going to go up because the dollar is dropping. So if we get euro dollar up, it's going up massively. Right? Similarly with GBP USD, because we have USD as the other pair that it's paired against, right? Similarly with euro dollar, right? Literally euro against the dollar, and because the dollar's weak, euro is going to go up. Similarly, I said similarly quite a lot, haven't I? I need to change my vocabulary up, but here we go, right? GBP USD, dollar's weak, GBP shoots up. And then this is the really important part. Do you know how I said AUD USD is very weak? And it is. Just look at it overall, right? It's dropping massively. Because the dollar is weak and it's dropping, so let's just get this up. Because the dollar, like we said, is dropping, what that means is that AUD USD, even though the Australian dollar itself, so this Australian dollar, the actual country and its currency, is very weak and dropping massively, the dollar is a lot more weaker, or at least relative to the Australian dollar, the dollar is a lot more weaker. So AUD USD will be dragged up, right? Because both currencies are weak, but the US dollar is a lot more weaker. Not a lot more, but it's just a bit more weaker than AUD USD. This is why we get this slow, little lethargic, choppy bit of price moving up, right? That's why we get that, because the Australian dollar itself is bearish, right? But the US dollar is even more bearish, so it slowly drags up. Same thing with NZD USD, right? That's why price is slowly moving up. And we'll talk more about this when we get onto the lower time frames. But I mean, you can see, right? I can be here literally for hours and hours and hours explaining daily bias, right? But really important. And if you understood that, how the Australian dollar is bearish, but the US dollar is even more bearish, that's why we're slowly dragging up. Congratulations, because I don't think trading gets any more difficult than that. If you're using the weekly chart, apart from getting the overall trend or direction, the second thing you want to do is you want to study the most recent bit of price action, right? This recent bit of price action here. I do not care about this order block here. I do not care about this, little liquidity sweep or this fair value gap. I care about this most recent bit of price action, because even as a swing trader, right, price action from 2 years ago down here does not really matter, right? This is what matters here, because this is what price is actually doing. So, and again, your job for daily bias is essentially to predict the future. Now, I say that, in quotations, right? You want to do it with probability, right? No one knows exactly what's going to happen. However, using this analysis, you can add to your win rate. And all you need is literally a 50% win rate and a 2 risk to reward ratio, and you can become a millionaire, which is pretty crazy when you think about it. However, what I like to do now that I've got the overall trend, is to study the most recent bit of price action. And what I like to do is there's really 3 things I look for. The first is liquidity, which I'm going to talk about later, because we're basically at all-time highs here. So there's not really much liquidity. There will be, of course, liquidity at this high. The second thing I like to do is I like to study order blocks and fair value gaps. Now, if you don't know what an order block is, go look at this picture on screen now. But when you're bullish, which remember, we are, because we have the overall weekly trend was bullish, is an order block is simply the last down close candle before the up move. So this is an order block. This right here is an order block, right? So what we're going to do, and this is really interesting now, is I'm going to mark out this entire thing, which is the order block, right? This entire thing here is the order block. Now, can you see how price taps this order block and instantly on the weekly chart starts to shoot off, right? That right there is respect, right? That is respect of an order block, right? If price did this, if it came all the way down here, that would not be respect at all. In fact, we'd think price would come and take out this low here. But the fact that price is touching it and already is starting to move off is a very strong sign. Now, another golden nugget, which I normally give to my private students, but I'm going to give it to you because I love making these analysis videos, is can you see the upper part of this wick? Right, can you see how essentially this is the entire order block? This wick here, can you see how price is almost like contained within this wick? Right, I hope that makes sense. You see this wick here, how price is contained into it and it's starting to move off. That right there is a very, very strong sign in price action that you won't hear literally anybody talk about. If price stays in the upper part of the wick, or let's say it stays in the wick only, and it does not touch the body of the order block and starts to shoot off, that is a very, very, very strong sign that the market is still bullish, right? So can you see our price already? And again, if you go on the daily chart, it's going to be a lot more obvious, but I'm just showing you it on the weekly chart, because do you remember how I was saying right at the beginning, the weekly chart tells you everything? It literally, you can get everything you need on the weekly chart, obviously apart from entries, right? But again, can you see our price stays within the upper part of this wick? It stays in this wick and it starts to shoot off. It does not touch the body of the order block, right? That is a very strong sign in price action that this market wants to move, right? Price is so bullish, it couldn't even get to this order block's body, right? Really, really important. So let's just clean up these charts. What have we done on the weekly chart, right? Let's just summarize very quickly what we have done. We know the overall trend is bullish, and we've seen price slowly start to retrace into an order block, but it's being held in this wick here, right? So we've got our overall trend. We know that price is respecting this weekly order block. What we're going to do now is we're going to get onto the daily chart, right? We're going to get onto the daily chart, and essentially
We're just going to look at this overall, again, as always, the most recent bit in price action, right? We're not going to get on the daily chart and come all the way down here and look at this liquidity sweep, right? Which is really nice, right? We're not going to look at this liquidity sweep. We don't really care about that, right? We care about this bit of price action here, right? So now remember this, you can imagine on the weekly chart, this is the big order block, right? All of these down close candles merged together would be your weekly order block. But what I want to see here on the daily chart is I want to study price action again. However, I am operating under the assumption that we are bullish overall based off the weekly chart. I just want to see what price is doing. Now, you might be wondering, oh, Atif, you know, if we're bullish, if we are so bullish, then why has price on the daily chart started to retrace? Now, this is a massive, super important concept that's very hard to understand, but once you understand it, your whole perception of the markets will change, right? So obviously, you know, if you've been trading for any length of time, markets do not move in straight lines, right? There will always be retracements and stuff. So, and again, this is all-time highs here. I cannot stress this enough. This is all-time highs. This is the highest that Bitcoin's been. So let's smart this out, right? This is all-time highs. Now, naturally, at all-time highs, there will always be people shorting, right? Trying to pick the tops of Bitcoin. People are going to think this is going to go below 100 all the way down, right, to 50K or whatever, right? You can imagine people are shorting and they're going to put their stops at all-time highs. So there's lots of liquidity naturally built at these highs here, right? So liquidity, and for those who don't know, liquidity is simply stop loss orders, right? It's the only reason these markets are actually moving, for liquidity, for stop loss orders, where there's clusters of stop loss orders, right? Now, order blocks and fair value gaps will tell you the intention. However, liquidity will tell you the direction. So really important concept there. Now, why price is retracing is, you know, like I said, right? Smart money, they're not just going to buy at all-time highs and hope and gamble that price is going to go to 130, right? What's really happening here is price is essentially going down to go up, and when the market's bearish, it will go up to go down, right? Now that sounds pretty crazy, but what I actually mean is that price is slowly, and this is also really important, look how price slowly retraces to allow smart money to get their high probability entries at fair value gaps, at order blocks, like we saw on the weekly chart. Remember that big order block? That allows smart money to get their entries. Now, an easy way, or almost a mathematical way of saying buy the dip, is this, right? So you see this low here, which is also a liquidity sweep, which is pretty cool, right? Look at this. See how the wick, you might help you. And if you don't know what a liquidity sweep is, check out this picture on screen now. Nice clean image of a liquidity sweep. Essentially, it's a stop run. Now remember, we are bullish overall. So that's why we did all the analysis on the weekly chart, so we know the direction. If I did not know what the weekly chart was telling me, right, if I didn't look at the weekly chart, I would have no idea what this is, right? I don't know if this is a sweep or this is a sweep, but because we're bullish overall, I know this is a sweep and this is liquidity, right? Really important there. So can you see how price takes out this low, instantly shoots off, takes out the, I guess, this high here, leaves all-time highs and starts to retrace. Really, really important bit of price action. And if you wanted to trade the daily chart, which you can, you've got your sweep, you have your bias, fair value gap can be your entry, and you know, it works. It works on all time frames. However, you get the Fibonacci from the low all the way to this high, right? Now this right here, this 0.5 level, this is the 50% level. Now anything below this 50% level will be cheap, right? Discount, buy the dip, sell the rallies, right? This is a mathematical way of saying buy the dip, right? Anything that goes below 50% level, that is a mathematical way of saying buy the dip. Now I say mathematical almost in a strange way. First of all, I've got a maths degree, that's why I'm saying it. Number two is their algorithms are coded, right? This is how they're actually coded, right? If it goes below the 50% level, that's their buy signal. And they're not just going to randomly start buying because price goes below the 50% level. What they are going to do though, is they're going to look for order blocks, fair value gaps, all that good stuff here. So if we could just get rid of that, that's what they're going to look for. Now, remember, this right here, approximately this right here is that big, you know, that weekly order block that we talked about. So right here was a great buying opportunity. Now, depending on how far smart money want this retracement to go, I could easily see price coming towards, see this fair value gap here, which would be a great buying opportunity for smart money, right? Can you see, you can easily see price tapping this fair value gap before shooting off, right? So what have we done on the daily chart? The daily chart is starting to give us the overall, the recent context of price action. The weekly chart tells us the overall direction. Daily chart starting to tell us, okay, what is price likely to do next, right? Because daily buyers, we want to know, okay, what is price likely to do next? So we've come to the conclusion on the weekly chart that the market's bullish overall, and on the daily chart that the markets are actually going down just so they can go up, right? It's going down just to give smart money their high probability retracements on the big weekly order block like we saw, the fair value gap, and depending on, you know, what smart money want to do is they could take out, see how we have the 100K level here? Let me just remove this. See how we've got $100,000 here? You know how, like, you probably remember this. You know when Bitcoin hit 100K, it was all over the news. Like whatever news station you have in your country, it was all over the news. You could easily see smart money even taking this price below this old low for liquidity, going below 100K, and people are like, oh my God, Bitcoin's going to crash, sell, sell, sell. And then smart money starts buying, maybe buying in this fair value gap, and then riding price over. But the key thing is Bitcoin is bullish overall. Smart money want to push this market up. Who knows where the retracement will be? If you're a trader, the highest probability direction will always be looking for longs. You can counter trend, and by counter trend I mean you can sell on this way down. However, just beware, it is lower probabilities. Okay, so here we are on the 4-hour chart, and like I said, I've not seen the 4-hour chart, so I just want to show you what my thoughts are. So the first thing I want to see is I just want to see order blocks getting respected. And if we look at this down close candle here, let me mark it out, right? This candle right here. Look at how price respects it beautifully. Look at that. Let me just mark the body out. Right, we just look at that. Look at the wicks. We just tap the order block's body twice, and then we shoot off aggressively and massively in the opposite direction. Let's just zoom all the way out. We shoot off aggressively in the opposite direction. What this means is the order flow, and the order flow just means the overall direction is bullish. Right, so don't get confused by the terminology with order flow. Liquidity sweeps. Liquidity sweep is just a stop run. Liquidity is just stop loss orders. Order flow is just a direction on whatever time frame they're talking about. And don't get a lot of people want to sound smart. A lot of people want to sound smart, but you know it's very, very simple when you start to understand what's actually going on. So this order block's being respected, and this order block here, and again, this is what I always like to see. So smart this out. Here's a bullish order block that price doesn't touch, does not touch it. Very, very nice to see that, right? Because like I said, you know, usually you want to see price hit it quickly and aggressively move off in the opposite direction. If price does not even touch it because it's so bullish, that's an even stronger sign. That's an even stronger sign that price is bullish, right? So now that we've studied our price action, we've done all the hard work on the higher time frames. Now I want to look for targets. Where's the most obvious liquidity target? And if we zoom out to the left-hand side of the chart, where is the most obvious liquidity target? And I'm literally telling you guys before I've even spoke about it. This is our obvious liquidity. Now, why? Let's just suppose this was bearish, right? So let's just suppose this was a bearish order block. Does that look like price has respected the order block, the bearish order block? No, not at all. Look how deep we've retraced, right? We've almost retraced 75% into the order block, right? That is not bearish at all. If price was bearish, it would tap the order block, almost like it did here. It would tap the order block and then quickly move off like that. Right, we don't have that at all. In fact, we've got price respecting bullish order blocks, completely disrespecting bearish order blocks. That's exactly what we want to see. And at this point here, we're just looking for our targets. So at this high here is our liquidity. And for those who are wondering, oh, you know, see, why is there not liquidity at this low or this low here? This is why. This is how we actually know that price is going to go through liquidity, by doing the higher time frame analysis, daily buys, all the boring but profitable stuff. That's how you actually know and that this liquidity pool is going to get taken, right? Like, I'm not looking at this low, you know, when price retraces. I'm not going to think, oh, you know, there's liquidity here, price is going to take it. I'm only looking at this high because we've done all the analysis on the higher time frame. So let's just mark this out. So right here is liquidity. And for those who always get confused about what liquidity actually is, it's just stop loss orders, right? It's where the money is, because these large banks, hedge funds can only get into their positions and out of their positions where there's billions and billions of dollars. And on dollar yen, on the 4-hour chart, there are billions of dollars at this high here, right? And at this low here, right? Very, very important. That's so price is going to go and target these highs here. Now, what does that mean? What does this really mean? All of this, you know, analysis that I've told you on the higher time frame that we have all-time highs. What does it actually mean for us as traders? So this is where things get a bit, not difficult, but it's different for every single trader depending on what your trading model actually is. For me, as a 4-hour chart trader, right, as a swing trader, I'm just looking for longs, right? So this would be an example of my entry. Like this, right? Fibonacci, I enter at the 0.705 level. There's no magic in this number. There's no, you know, secret Fibonacci. It's just an easy way of entering it. And I learned from ICT, and this is what he used, so I just stuck with it. This is my entry, my very sophisticated advanced entry. Just in the Fibonacci retracement, and I target a 3-to-1 in a direction. Notice how I don't target the actual liquidity pool itself, because you don't really need to, right? Price could retrace. So for me, I'm happy, and I strongly recommend you either just aim for a 2 or 3 risk to reward ratio in the liquidity direction. You don't have to target liquidity. You don't have to do anything fancy, especially as a day trader. I get people telling me, you know, as a day trader, let's just imagine this is the 1 minute chart, right? All the way over here, and the stop loss is like this, right? This is the 1 minute chart, and they're like, oh, Atif, do I have to target this liquidity pool on the day? No, no, you don't. We just have to trade in the direction. So let's just remove this. And that's what a swing trader would do. You just ride price up. If you're a day trader, scalper, any of that sort of stuff, you're going to get onto your entry time frame, and you're just going to take every single long entry you see. You're not going to take any bearish entry. You're not going to try and short down to this fair value gap. You're just going to take any bullish entry to this liquidity pool here.
Okay, so what is liquidity actually, right? We hear about this all the time, liquidity. What actually is it? It's simply highs and lows, right? Highs and lows. Most importantly, on the higher time frames, so the daily and the 4 hour, key highs and key lows will have lots of orders there. Now, what do we mean by orders? We mean stop loss orders. Now, why is that important? Stop loss orders will have billions of dollars, right? Remember, on the daily chart for gold, there'll be billions of dollars at this low and this high, right? People shorting will have their stop losses here, and people going long will have their stop losses here. And by people, I'm talking about smart money. Now, smart money are large banks, large institutions, hedge funds, all that sort of stuff, who have billions of dollars, and they move the market. We don't move the market. Day traders don't move the market. Scalpers don't. It's them with billions of dollars. They move the market. And in order for them to actually get their orders filled, and what that means is for them to actually get into a trade, is they have to do business at key highs or key lows, right? That's it. That's what liquidity really is. So these markets will only move for higher time frame liquidity. And this is so important because so many people understand, you know, key highs and key lows, but then they look at, you know, the 1 hour key high and they think that's the most important thing, when they don't realize there's a key low on the daily chart that price is going for. And right, so we're on gold, we're on the daily chart, and we're going to look for the most obvious high or low that price is going to go for. And I hope it's pretty clear. Maybe it's a bit bigger. We're going to go for this low here. Now, why are we going to go for this low? Let's mark it out. There's lots of liquidity at this low. We know it's a key low. We know that gold's been in the bull market, right? So people have trailed up their stop losses here, here, and here, right? Some people might have had it here. But here, there's so much liquidity. There's so many orders here for smart money to target. And another thing you can do whenever you're unsure whether price is going to go for this low is just look at the order block, right? So we're going to look at this order block here. So I'm going to mark out the order block, which is just the last down close candle before the up move, like that, right? You see how price like aggressively comes into it and wicks deep within it? That right there isn't really respect of an order block, right? Because what you would expect if it was a valid order block and we were still bullish, you'd expect price just to tap it with a wick and then quickly move off, right? But we don't have that. We have a massive aggressive down close candle. And when you see candles like this and you see the candle closing into the order block and wicking deeply, that shows you there's complete disrespect of the order block. Right, we're not bullish in any way, sense, or form, right? Complete disrespect of this order block, and we've got key liquidity here. Now you might hear this being called a liquidity pool, right, or whatever. The terminology is not important, but what we know is that for gold, currently, we're going to go for this key low. This key low, there's been no respect of the order block, and we've got this obvious key low. Now, what does this mean? Because so many people get this wrong. This right here is your daily bias, right? So we've already figured out daily bias just by using liquidity. We've used liquidity and we know our daily buys. Now that means when we get on the lower time frames, we're only going to look for shorts on gold. We're only going to look for shorts, right? So many people, they do this and then they start looking for longs on the lower time frames because it looks bullish. You don't do that. You only look for shorts. But, and this is so important, when we get in the lower time frames, we're going to look for liquidity sweeps. Right? We're going to look for liquidity sweeps. Now I'm going to explain more about that when we get into the lower time frame.
Okay, so liquidity is simply stop loss orders, and you'll find liquidity at major highs and major lows on any time frame that you trade. But the higher the time frame, the more important the liquidity is. Now, this is what's super important about liquidity. Liquidity is only there to give you the direction of the market. That's the only reason we care about liquidity. It's not an entry pattern. It's not a technique. It's just a tool, right? A concept to help you predict where price is going to go. Because let me tell you this, after 5 years of trading, once you got the direction right, you are 90% of the way there. All you need is a simple entry pattern. So liquidity gives you the direction of the market. Once you got the liquidity right, you'll know 9 times out of 10 where price wants to go. So you will find liquidity at major highs and major lows. And what happens with liquidity, especially on the higher time frames, either the 4 hour, daily or weekly chart, is this will act as like a magnet for price action, literally pulling price towards it. So what that looks like is this will literally magnetize price towards it, right? On the lower time frames, just pulling price towards it. And there are so many entries that you can get, right? There's so many easy entries that you can get on the 5 minute, 1 minute, 15 minute, even the 1 hour chart riding price up to key liquidity pools, right? And if you're ever unsure about what liquidity, price wants to go for on the overall time frame, this is the technique, this is the tool. So make sure you pay close attention to this. You get onto the 4-hour chart like you are now, and let's just imagine you get on the chart and this is what you see, right? This is live trading right here for you. You've got to just ask yourself, which high or low are we likely to go for, right? And it's pretty obvious in this case, but it's not always going to be obvious to you, right? So make sure you do pay attention here, right? You're going to come on the charts and you're like, are we more likely to go for this low all the way down here, this major low here with stop loss orders, or are we more likely to do this? Are we more likely to come up and take out this high here, right? Hopefully, pretty obvious, at least in this case, that we're likely to take out this high, right? But that is your technique for finding the liquidity, finding the daily buyers. It's to just get on the 4-hour chart and ask yourself, which major high or low is price likely to go for? And that right there will give you daily buys, weekly expansion, weekly buys, whatever you want to call it. That is how you determine daily buys. You don't need to mess around with multiple time frames, the monthly chart. Just get on the 4-hour chart and ask yourself which high or low is price likely to go for. But now that we've got our liquidity, we know that this is our target, right? So when we get onto the lower time frames, we are only going to trade in this direction. We are only going to look for longs to ride price up to this target here, because that is the highest probability entry.
Now, for those who struggle, there are multiple different terminologies, for saying liquidity. So liquidity, the exact same thing that liquidity is stop loss orders, right? That is all that liquidity is. It's just resting stop loss orders. And, the way that we know that stop loss orders are going to be there is because there are traders who still trade support and resistance, right? There are still traders who trade support and resistance. Now, at this level here, and we're on gold, we're on a daily chart, right? At this level here, this key daily high, and in fact, this is all-time highs. Lots of people are shorting gold, right? They think this is an all-time high. They're going to put their stop loss orders here, and they think that when the price comes all the way up, it's going to bounce off this level and continue down, right? That's what support and resistance traders think, right? Now, if you've been trading for any length of time, you know that's a complete load of BS. It does not work. It does not work. And, I spent years trying to trade that way. It does not work at all. Now, what we do know, though, is there's going to be lots of liquidity, right? Lots of stop loss orders at these key highs and key lows. And now what we want to do as a liquidity trader is we just want to target that, right? We just want to target stop loss orders, or we just want to target liquidity, right? It's that simple. That's all we need to do. So all we need, right, in terms of liquidity, is we just need to see on a higher time frame. So in this case, the daily chart, where price actually wants to go. Now, this is something for your notes. Price will move for where the money is, right? They'll move for where the money is. Now, the money is essentially where people's stop loss orders are, because smart money who move the markets, who have billions of dollars, they can't just trade on the 5-minute chart or the 1-minute chart. They can only get in and out of their positions at key highs like here and key lows like here, right? Where there's going to be lots of stop loss orders. That's the only way smart money, so like Goldman Sachs, JP Morgan, and hedge funds, pension funds, the only way they can get in and out of market is at key highs and key lows when there's lots of liquidity, right? Lots of stop loss orders. So price will move to these highs and to these lows. Now, why does that matter for us as traders, right? The only reason it matters is it gives us the direction of the market. Right? It's so important. The only reason we look at liquidity on the higher time frames is it gives us the direction of the market. That's all we need, is a direction. If we've got a direction, you're 90% of the way there. Right? That's only so long. And most of your time in trading shouldn't be spent on finessing some sort of entry. It should be spent on getting the direction right. Because if you can get the direction right, you're literally 90% of the way there. All you need is a simple entry model. Because look at this, right? Look at this. All you needed was a few good longs here, right? Getting, let's say, a free risk reward ratio. You would have made a lot of money. A lot of money. This is the overall direction of the market. Can you imagine you trying to short in this, right? Imagine shorting it against all these up-close daily candles, right? Low probability, but trading with the trend, trading where price wants to go to liquidity is the highest probability in all trading. So right now, we know that price is bullish. We know that price wants to move for stop loss orders on the higher time frame, because that's the only way that smart money can get in, right? That is why, price isn't bullish because, let me show you, it's not bullish because there's been some sort of market structure shift, right? Because the body here has closed above this high. That is not the reason why the market is bullish, right? You got to think, is Goldman Sachs really, right? Or, is any big bank, big investment bank, are they really going to buy and sell based on a market structure shift? Oh, we've had a market structure shift on the 4-hour chart. We've got to sell now. No, that's not what it is. It's all for liquidity, right? It's all for liquidity. So here we are on the daily chart. We know there's lots of stop loss orders here. and price is going to move for those stop loss orders. So all we need now is to go on the 5-minute chart or any lower time frame and just trade in that direction.
You're going to use the 15-minute chart, right? And you're going to zoom out and you're going to look for the most obvious highs or lows. Now, I hope it's pretty obvious, and I've marked it out for you. I hope it's pretty obvious. We've got liquidity here, here, here. We've got almost triple highs on gold, right? There's lots of liquidity. There's lots of stop loss orders at this high here, right? So we just mark this out. Lots of liquidity, which is just another way of saying stop loss orders. So don't get confused by the terminology, right? That's all liquidity is. It's just stop loss orders, right? Right here, there's so many people shorting gold, hoping, this is all-time highs, right? And they're trying to ride gold down, and they see a bit of bearish movement here, so they're even more confident. As price comes up, more and more people are shorting, hoping, right? They're hoping that price is going to come all the way up and bounce back down. Now, if you've been trading for any length of time, you'll know that price does not bounce at random support and resistance levels. What will happen is, if we are bearish, price will come up, it will take out these stop loss orders here, and then it will start to reverse. Or what could happen is, if we're bullish, right, if we are bullish, price will just smash right through these levels, right? If you notice, in both scenarios, both bullish and bearish scenarios, price is going to move up towards this key high, right? Now, what we do at that level, whether we reverse or continue, doesn't matter. All we need to know is that price is going to move towards this key level here, right? Because there's lots of stop loss orders. That's all we need to know. Now, you might be asking, why do we need to know that? Because that gives us the overall direction of the market, right? That's the only reason we use liquidity. Very, very important you understand that. We don't use liquidity for anything else apart from giving us the direction of the market, right? Liquidity is not for your entries. Liquidity sweeps, which we'll talk about later on, that is what you use for your entries. So right here is our liquidity. That tells us that we're bullish and that we're going to take out these highs, or at least we're going to trade in that direction. So what that means is, when we get on the 1 minute or 5 minutes to look for our entries, we're only going to look for longs, right? Very, very important that you understand that. Lots of people, they don't understand why we actually use or care about liquidity. The reason we care about liquidity is because it gives us the direction of the market. That's it. That's the only thing we care about, is a direction. Because if you don't have a direction when you're trading, you're gambling. You need to have a direction. You need to have at least, some logic or confidence of why price is going to go in that direction. So we know lots of stop loss orders here, lots of liquidity, very, very likely that we're going to trade in that direction.
Okay, so what is liquidity? We hear all this talk about liquidity. What actually is it? It's simply, where are the stop loss orders, right? That is it. That's all liquidity is. You've got to ask yourself, where are the stop loss orders? Because these markets will only move for where the money is, right? Very, very important. Make sure you write it down, that these markets will only move for where the money is on the higher time frames, because these markets, I'm sure everyone knows, are moved by big banks, big insurance companies, hedge funds. They're the ones who move markets, right? If you want to move euro dollar, the SMT, any major market, even crypto, you need billions and billions of dollars. And the only way these institutions with billions of dollars can get in and out of their positions are at key highs and key lows on the higher time frame. That's where all the money's going to be. That's where all the stop loss orders are going to be. And the reason there are stop loss orders, and we all know this, is because of support and resistance, right? We all heard, that price at this level here is key resistance because we've got a high here and high here, high here, high here. So what they think, or what traders think, that price is going to come up like it's done here, and it's going to bounce off, right? It's going to bounce off this level and go down. Now, if you've been trading for more than 3 months, that's a complete load of BS. It does not happen. What actually happens is that price smashes through these levels, right? The only reason we have equal highs here is just to generate liquidity, right? Just to get people start shorting the euro dollar so we can smash right through it. That's the only reason these highs are impact, right? So that is what liquidity is. That is literally all liquidity is. And the only reason these markets are going to move are for these higher time frame stop loss orders, right? Because there are hedge funds that have their stop loss orders here, right? And you might not believe it. You might think, oh, doesn't everyone know about liquidity? Trust me, there are so many hedge funds. There's essentially two ways of looking at it. First, there are hedge funds that have literally a 10% win rate or below, and then they aim for massive trends. They're going to hold for years. As day traders or swing traders, we don't want to hold for years. But they're looking to capture, massive trends over years, and they're happy to get, lose 9 times out of 10, and then the one trade that they do win, they hold on for years, and then get like a 20 risk to reward ratio. That's one type of hedge funds. The other type of hedge funds, and you've probably heard this stat where it's like 90% of hedge funds underperform the S&P 500, and they make the majority of their money from churning. Now, what that means is the hedge fund makes their money from getting in and out of positions, right? They make all their money from commission, not from actually making a return for the investor. Now, I'm not going to talk too much about that, but trust me, I worked at a big bank, and these big banks will literally rob investors of their money. They make all their money from commissions. They don't care whether their investors lose or win. They don't give a shit. They make all their money from. But anyway, all you need to know for trading is that at these highs here, there is so much liquidity, there's so much stop loss orders, and that the market is going to move for this, right? That's all we need for liquidity, right? All liquidity does is it gives us the direction of the market. So hopefully, clearly, we're bullish and we're looking to target these highs. So we're going to look for longs on euro dollar until we take out this high, right? And then we'll see what price does, right? If price just smashes right through, then okay, we'll look for the next liquidity over here. But if we get some consolidation like this, we'll just wait a few days and then see what price it does. Because they want to go up, or is it going to start reverse, right? That is all we need for liquidity. Liquidity gives us our direction. Now, most people, maybe if you look at liquidity, you might understand that. You probably understand that. Now, hopefully that makes sense, right? Markets will only move for higher time frame stop loss orders. It's the only way big banks and big, insurance companies, hedge funds can get in and out of their position. What liquidity does is it gives you the direction of the market. We know the direction, we know we're bullish, but that alone is not enough to make money, because for years I could get the direction right, but I couldn't make money. And the reason why is because I didn't wait for the liquidity sweep. So I'm going to get a lower time frames. I'm going to show you what a liquidity sweep is and how you can enter on the highest probability trades possible. Okay, so the first thing you need for liquidity is you need to use a higher time frame, right? So you've got to use either the 4-hour or the daily chart, because this gives us the direction of the market, right? The first thing we need to do before you get onto the charts, or as soon as you get on the charts, is you need to have a direction. You need to figure out where is price most likely to go. Is it likely to be bullish, right? Is it likely to do something like this, enter on a retracement and take out some sort of high? Or is it likely to do this, right? Is it likely to be bearish like this? Or third of all, which not many people talk about, is it likely to just consolidate? Because if it's likely to consolidate, don't trade, right? That takes some discipline not to trade. But for the direction of the market, the only thing you need to use is liquidity, right? You don't need to use breaker blocks, order blocks, fair value gaps. You don't need any of that. You don't need volume profile. You just need good old liquidity. Now, liquidity, for those who don't know, it's essentially where would people put their stop loss orders, right? We're on the higher time frame, we're on gold, and this is a major market. It's probably one of the biggest markets in the world, right? Apart from like the SMT 500 and euro dollar, gold is probably one of the biggest markets in the world, right? There are billions and billions of dollars. There's huge institutions all looking at the 4-hour chart and the daily chart, and at this key high here, right? There are people shorting gold because they think it's at at all-time highs, and then there are people who want to buy gold. Now, for those who are going to ask me, and I personally think we're going to hit 3,000 on gold. That's just what I think. But nevertheless, what we need to use for the buyers or for the direction of the market is we just need to look for where is the most obvious stop loss orders, right? Now, I hope it's pretty clear, right? It's pretty clear. We're in a bull market. Let me just zoom all the way out, actually. We're in a bull market on gold, right? You never ever short these things. It's pretty obvious that price wants to go to this high here, right? It wants to go to this high here because there's lots of people shorting. There's lots of people who use support and resistance, right? Who think that price is going to come up to this level and then bounce off like that, right? Now, if you've been trading for any amount of time, probably about more than 3 months, you'll know that is a complete load of BS, right? If price was to reverse, what it would actually do is it would do that, right? It would go up slightly. It would take out anyone who had their stop loss orders here, which is a liquidity sweep, and then it would reverse, right? And you probably had this all the time when, let's say, you're using support and resistance and you thought price was going to go down. It does, but it takes out your stop loss and then goes, right? Because these markets only move for stop loss orders, and they're highly, highly manipulated. And me and you, as retail traders, we're not supposed to be profitable. This is not for us. This is for the big boys. So these markets are highly, highly manipulated, and they run purely based on liquidity. But we've got the direction of the market, right? We know where the higher time frame liquidity is. We know where the where the market actually wants to go. We're going to expect price to move up like that, and then we want to enter any sort of retracement on the lower time frames, right? We expect price to come up and then break through this level. So now that we've got the direction of the market, right, all we're going to do is we're going to get in the lower time frames and we're going to look for our entries. That right there is so important. I'm not on the 5-minute chart trying to predict where price is going to go. I'm on the 4-hour chart and daily chart looking for the higher time frame liquidity, the bigger picture. I've got my direction now, so I don't care what the 5-minute or 1-minute chart's doing. I'm only going to look for longs. So very, very important. That very, very important. You don't need to use lower time frames for your bias. Use the higher time frames for your direction, and then use the lower time frames for your entry.
Okay, so what actually is a liquidity sweep? It is simply a stop run, right? That's what it is. And you hear this be called, all sorts of names. Judas swing, fake move, purge, liquidity purge, runs, grabs, whatever you want to call it. What I'm referring to in this video, and the only thing you really need to understand, is a stop run, because the only reason this market's move is for one concept, which is liquidity. Now, most people think they understand liquidity. However, liquidity is actually broken into 2 parts, right? The first part is where you use the higher time frames, like the 4-hour and daily, and you target major highs and major lows. That gives you your buyers, your daily buyers, your top-down analysis, your direction for the market, which you always need. Now, I'm not going to explain that in this video. There are plenty of videos on this channel where I talk about that. I'm literally the liquidity king, right? There's so many videos where I explain that. I'm actually going to explain step 2 in the process, which is a liquidity sweep. Before you enter your trade, you need to be waiting for a sweep. You need to be waiting for stops to be taken out, because if you don't, price is going to come down and it's going to take out your stop loss. Because let's just suppose, for example, you wanted to enter on this order block here, right? You know we're bullish. And again, I'm not going to talk about why we're bullish, and you can almost see it in price action here, but I'm not going to explain it in this video. To do that, you use the higher time frames. I just want to explain what sweep is, because like I said, if you understand the sweep, everything else falls into place, right? This is the key thing in trading you need to understand, because you won't make money unless you really understand this. So let's just imagine you entered on this order block, right? You're bullish, there's fair value gaps, does not matter, but you enter on this order block, and you're going to put your stop at the order block low, right? And what happens here? What actually happens here? Price completely disrespects your order block, taking out your stop loss just to shoot off. And then it seems, almost to spite you, it seems to give everybody else a nice happy entry, order blocks, fair value gaps, great risk to reward, and go straight off to take profit, right? Be honest, has that happened to you before? You've got the direction right, you enter on an order block, fair value gap, VWAP, and you still lose, only to see price go off in the opposite direction, right? That used to happen to me all the time, and it's the most annoying thing in the world, right? You feel like you've literally been robbed because you got everything right, but you still lose. And the reason why is because you haven't waited for a liquidity sweep, which is a stop run. Now, I'm going to put a nice graphic on screen now of what a liquidity sweep looks like when you're bullish. So you probably want to pause the video and just study that for a bit. However, I'm just going to show you it in price action, right? So the first thing I'm going to do is I'm going to show you this on this path tool here. Now, what a sweep is when we're bullish, and you just flip it on its head when you're bearish, right? So when you're bullish, this is what you're going to look for. You're going to look for price to shoot off in the direction, obviously bullish direction. You're going to look for price to come down, take out the old low where people would have their stop loss orders, and then instantly shoot off in the opposite direction. Now, price does not need to take out this high. It does not need to be a market structure shift, right? We do not need market structure at all. If it happens, it happens, right? But similarly, this could happen. Or price could be equal highs, right? Does not matter. There does not need to be a shift. However, what needs to happen is price needs to take out an old low, quickly shoot off, and then what will almost always happen is price will retrace, give smart money traders their nice entry on a fair value gap, on an order block, VWAP, Fibonacci, whatever you want to trade, and then price will shoot off. You will see this all the time in price action. It's insane. And in fact, before every big move, there will always be a liquidity sweep. You can actually see one here, and almost a little baby one that sweeps out liquidity here. But again, we're not going to talk about this one. This one here is a really obvious one. So what we're going to do is let's just clean these charts up. So now I actually have a question for you, right? Based on what you've just seen with a nice graphic and that blue liquidity sweep, which low out of these three, so this one, and this one, is the liquidity sweep, right? So which low out of these three takes out stop loss orders, right? Because remember, a liquidity sweep takes out stop loss orders. Which one is it? Is it this low? Does this low take out stop loss orders? Does this low take out stop loss orders? Or is it this low? Right? Now, if you got this right, congratulations. This right here is our liquidity sweep. Now, why is it a sweep? We have lows here. Price comes down. It takes out the low here where people would have their stop loss orders. Remember, people would have had their stops around here. They would have seen this huge move and trailed their stop here. Price comes down just enough. It wicks just below it to take out stop loss orders. Shoots off in the opposite direction. There's no market. I mean, you know, if you want to use this high, but again, like I said, market structure does not matter. Price retraces. Nice, easy entry on a fair value gap, on an order block. Ride price off. Right? Easy peasy. This is what happens, and this is what a liquidity sweep actually is. But we need to wait for stops to be taken. So this right here is the sweep, right? This low right here. I mean, just look at this, right? Look at this. We have two candles that wick below it, and price instantly and aggressively moves off in the opposite direction. Look at this bit of price action here. Look how awful this is. Price slowly chops down just below this old low, right? Price isn't going anywhere randomly. It's going for this low to take out stop loss orders, and then quickly and aggressively shoots off. Tracement, shoots off again, right? You'll see this happen in every market on every time frame. In futures, forex, crypto, commodities, whatever you want to trade, you'll see this over and over and over again. But just make sure you wait for a sweep, right? Because if you don't wait for a sweep, you're going to be the one that gets swept. And this was me for years. You're going to enter on the order block. You're going to get your daily bias right. You're going to target some liquidity, you know, on the 4-hour chart or daily chart. only to see price hit your stop loss, right? So once you've got your sweep, all you need now is a simple entry pattern. Now you might hear people say, and I say this all the time, the entry is the least important thing. It is, once you've got the direction and you've got your sweep, right? At this point here, any entry pattern will make money, even, you know, VWAP or, you know, moving average, whatever indicator you like, as long as you've got the sweep. So for me, I always think, and I always say this to my students, the easiest way to know it's a sweep and the easiest entry pattern is just to wait for a fair value gap to form in the opposite direction, right? Now, you don't need a fair value gap to know it's a sweep, but, you know, if you're just starting out and you're struggling, always wait for a fair value gap. And if you don't see it on the 5-minute chart, you'll see it on the 1-minute chart or even the second chart if you really want to look for a fair value gap. I think that's just the easiest way. I mean, just look at this, right? I mean, it is beautiful, isn't it? Our price just taps it, quickly shoots off, right? You'll see this happen in every single market. And if you don't believe me, don't take my word for it. Like, after this video, go into your charts and look for this, right? Look for this, train your mind. You know, you want to get to the point where you can close your eyes and see this, because I have dreams about trading, do you know what I mean? But you'll get to that point too, right? Where you literally mastered it. Now, for our entry, and this is really important, right? So let's say the fair value gap you want to enter on. And to remember, and well, I guess to emphasize, you can enter on the order block, Fibonacci. It does not matter. Your entry does not matter. However, your stop loss really does matter here, right? This is the most important part of the whole video, right? If you do not get this right, it's pointless to wait for a sweep and you're still going to get stopped out. You must put your stop loss at the liquidity sweep low when you're bullish, right? The whole reason we wait for a sweep is we wait for somewhere where we can put our stop in a safe place, right? It's very unlikely because remember, price came down here, but it didn't just come down here randomly. It came to take out this low here. Stops have already been rated. It's very unlikely that price is going to shoot off, come all the way down and take out stops again, right? Because it's already done that. Very, very unlikely. There is a chance, which is why we always have a stop loss. Very, very unlikely. I'm sure you can agree. Very unlikely that's going to happen, right? So we always put our stop at the low here, right? And if you want a better entry, go finesse it on the lower time frames, but you do not move your stop to this fair value gap. I know you get away with it in this example, but more often than not, your stop's going to get hit. You do not move your stop loss. Your stop loss is always fixed here. And if you want a better risk to reward ratio, you know, you're gonna have to you look for a better entry, right? But you do not move the stop loss, right? That's the most important part of this whole video. So if you understand that, congratulations. Okay, so for this strategy, we only need two things. We need a liquidity sweep and we need a fair value gap. Now, we're going to do this on the 1-minute chart because for scalping, we only need the 1-minute chart. We don't need daily bias because the reality is, you know, on the 1-minute chart, daily bias doesn't really matter that much. So here we are. So what a liquidity sweep really is can you see this major low here, right? This major low here where there's lots of liquidity, lots of stop loss orders, whatever you want to call it, at this low here, right? Because price, let me just zoom out here. See how price shoots all the way off, all the way up here. Lots of people are going to put their stop loss orders here, thinking it's nice and safe, right? Nice and safe. So if you've been trading for any length of time, you know that's complete BS, right? What the markets actually do is they target stop loss orders. It's the only reason these markets move. And I'm not going to prove it to you in this video. And all you need to know is that that's the reason why these markets move. So what a liquidity sweep really is, it's a fake move, right? It's a stop run, which takes out an old low and then shoots off in the opposite direction. And trust me, after 5 years of trading, and if you don't trust me, go look at the comments, right? You will see liquidity sweeps time and time and time again. And in fact, if there's any major move in the market, it will be because, first of all, there's a liquidity sweep, and then it will shoot off. So how do we actually make money with liquidity sweeps, right? This is the most important part, of liquidity sweeps. So let's just move this all the way over here. So you guys understand the logic by this point. So here's our liquidity sweep, right? Can you see, this is super important, right? Pay attention. This is probably the most important part of the video. Can you see this? Right, let me mark this out for you. Can you see our price comes just below, look at these candles here, these little ones here, just below this old low, right? Just below this old low, just enough to take out people's stop loss orders, right? And then shoots off aggressively, quickly in the opposite direction, and then gives everyone else a nice fair value gap entry, or nice order block entry, whatever you want to call it, retracement, and then shoots off, right? You will see that time and time again, and that's how I've retired my entire family, right? Liquidity sweep, simple entry. That is all you need to become a profitable trader, right? Especially when you're scalping, right? We don't need daily bias, just because that's how scalping works. So you will always see this liquidity sweep, fair value gap in the opposite direction. So to make a liquidity sweep high probability, we're going to wait for a fair value gap to form, right? So the moment this fair value gap here that I've marked out for you, the moment this forms, That right there is smart money screaming at you that this is a liquidity sweep. It's a fake move designed purely to take out stop loss orders. So once this fair value gap's formed, then and only then do we know this is a liquidity sweep. It's purely or simply just a fake move designed to take out stop loss orders. So once this fair value gap's formed on the 1 minute chart, then and only then am I going to look for my entry, right? And you can see price shoots off, which we always like to see. And I don't believe in market structure. I think it's a load of BS. That's just me personally. But, if you do believe in market structure, here's a high. Price closes above it. There's your market structure shift, right? If you do believe in that. But all you're going to do at this point is simply enter on the fair value gap like this. Put your stop always at the liquidity sweep below, right? The only reason we wait for liquidity sweep is to put our stop loss in the safest area possible. Now, for your take profit, you're going to aim for at least a 3-to-1 because personally, if you're scalping, there's no point aiming for a 2-to-1 because you can be a swing trader and get a really easy, reliable 2-to-1. So I'm going to aim for at least a 3-to-1, right? Which we just about get. And if not, you can aim for a lot higher, 4-to-1. This high right here, really obvious high to take. And if you really, really do want to, but again, at this point, if we aim really high, we're getting more into day trading sort of territory instead of scalping, right? So we zoom out. See, do we hit this? Yeah, eventually, right? But again, if you're scalping, you want to be in and out. So for me, as always, a free risk reward ratio is like the holy grail. Now you might be wondering, let's just make this all the way down here. You might be wondering, okay, Atif, why does this chop for a bit? Now the reason why this is choppy here is because this is the end of Asia, but it's not London yet, right? Asia is 8 p.m. till 12 a.m. Eastern, and London is all the way over here, right? All the way over here, 2 a.m. till 5 a.m. Eastern. So we've got a bit of dead time, but honestly, it does not matter, right? You can get an easy free risk reward ratio. And as a scalper, that's all we care about. Okay, so for this strategy, we only need 2 time frames, the 4-hour chart and then your entry time frame. Now, the reason we use the 4-hour chart is because this tells us where price actually wants to go, right? Because the big banks who move price, they're only looking at the higher time frame. So we need to use at least one higher time frame to give us high probability entries. But once we use the 4-hour chart, all we need after that is our entry time frame. So the only thing we need the 4-hour chart for is just to look for a fair value gap, right? That's the only thing we need the 4-hour chart for. So what I'm going to do is we're just going to mark out a fair value gap. And for those who don't know, a fair value gap is simply the gap between this candle here, this candle's high here, and this candle's low here. So what you're going to do is you're going to mark out that 4-hour fair value gap. And then literally all you're going to do now is get onto the lower time frame or your entry time frame and look for a new fair value gap to form in the same direction, right? So a new bullish fair value gap to form on the lower time frame. So let me show you what that looks like. Okay, so here we are on the 5-minute chart, right? And here's that 4-hour fair value gap, which we were talking about on the higher time frames, right? Now, can you see how price comes in, it chops around for a bit, and then boom, shoots off. That is exactly what we want to see, right? We want to see on the lower time frame or our entry time frame, we want to see price respecting the 4-hour fair value gap. And what respecting really means is for price to leave another fair value gap in the same direction as this 4-hour fair value gap. So what that actually looks like is, let's just mark this out. You see this fair value gap, see these big fair value gaps that form in the direction of the 4-hour fair value gap. That's telling us we're on the right side of the market. That's our confirmation that smart money, those who move price or who move the market, are telling us, they're screaming at us saying, hey, look, this is the right side of the market, right? Price is bullish. Getting on a trade, right? Getting on a trade on a fair value gap, on an order block, on an optimal trade entry, and ride price up, right? This is our confirmation, and this is what makes this strategy high probability, right? It's the fact that we've got our highest time frame fair value gap, and on the lower time frames we have our confirmation. And for those who are wondering, this strategy will work on any time frame less than the 4-hour chart, right? So 1 hour, 15 minute, 5 minute, 1 minute chart, and any time frame will do as long as it's less than the 4-hour chart. But you need to use the 4-hour chart as your higher time frame, right? Because smart money are looking at the higher time frame. But here we are. Here's the 4-hour fair value gap. Price hits it, aggressively shoots off, and then leaves another fair value gap, right? And you'll see this in the PDF, which you guys should have, right, in the pinned comment down below. But this fair value gap, or any fair value gap, right here is smart money screaming at us, telling us that this is the right side of the market. So for this strategy, once price hits this 4-hour fair value gap, you want to wait for the next fair value gap that forms in the same direction as the 4-hour fair value gap. Now what that really means is, this is the bullish fair value gap, we want another bullish fair value gap to form on our entry time frame, right? So here we are. And for those who are wondering, oh, Atif, why have you not used this fair value gap here, or even this one here, right? The reason why is, and this is for your notes, When you're bullish, you always take the lowest fair value gap, and when you're bearish, you always take the highest fair value gap. And that right there will save you so much money. It's actually insane, right? So what that actually looks like, because someone was getting confused, you know, in the comments, like, hey, what does that actually mean? Let's say you were bearish, this would be your highest fair value gap, and because we're bullish, this would be your lowest fair value gap, like this, right? Like that. And beautiful respect here, bro. Look at this. Look at the bodies respecting it. Always nice to see that. So for this strategy, what you're going to do is you're going to enter on the new fair value gap that forms, right? The new fair value gap, not the big 4-hour fair value gap, the new one that forms like this. And then for your stop loss, I'm just going to put it at this low because it seems nice and logical, right? Nice and logical. And then for your take profit, you're going to target at least a 2-to-1, or you may as well target this high right here. But for me personally, I always target a 3-to-1, right? Because I think, to be honest, I think a 3-to-1 is the best risk to reward and win rate combined in all of trading. Because obviously if you get a 5 or 10 risk to reward ratio, win rate goes down massively. And similarly, like, who wants a 1-to-1? Who wants to aim for a 1-to-1, right? Like, no one. So for me, this is my favorite here. Aim for a 3-to-1. Nice, easy, simple trading. Okay, so here we are on the 15-minute chart. So let's imagine that you didn't want to trade the 5-minute chart and you wanted a simple day trading strategy. Here's how you use the exact strategy on the 15-minute chart. So if you just zoom out, this right here, you can almost see it. This is the 4-hour fair value gap that forms. So realistically, I should be moving it in like this. But this is the 4-hour fair value gap. Price hits it, and if you remember for the strategy, what we're looking for is we're looking for the first bullish fair value gap that forms, right? And the reason we're looking for a bullish fair value gap is because the 4-hour one was bullish, right? So we're on the 15-minute chart here. This right here is the first bullish fair value gap that forms, right? Like that. That's your first bullish fair value gap. So what you're going to do is you're going to enter on the fair value gap like this, put your stop at the low here, and then for your take profit, you're going to target at least 2-to-1, minimum 2-to-1, or like I always do, nice, easy 3-to-1. Now, of course, you know, if you want to, you can target liquidity all the way up here, right? Nice, easy trade here, 4.5 risk to reward ratio, or you can target liquidity at this high here. Really does not matter, but as long as you've got this strategy, you've got the 4-hour fair value gap and the lower time frame fair value gap, you can make all the money in the world. It's insane. Okay, so for this model, and the model that I actually used, I made it as simple as possible because simplicity is what makes money in these markets, not some crazy indicator or invention. So what you're going to do is you're going to get on the 15-minute chart. Now, even if you don't trade the 15-minute chart, very useful if you're a day trader or scalper to at least look at the 15-minute chart. Now, what you're going to do is you're just going to eyeball the overall trend, right? You're just going to ask yourself, where is the market? Because we're at this point in the market. Where has the market been trending? Has it been going up or has it been going down, right? And literally, you know, there's no magic formula of, hey, look, you know, look back the last 3 days. Just eyeball it, right? And if you just get a trend line, now obviously, you know, I don't trade trend lines or anything, but if you just get a trend line and just put it through, right? It's pretty obvious that overall we've been bullish, right? Price has been going up. Obviously, there's lots of retracements. Let's go ahead. Lots of retracements and shit, but you know, price is bullish. We're moving up, right? We're moving up. We're bullish overall, right? So if we're bullish on the 15-minute chart and our trend is bullish, what that means, and this is a little trick, a little trading hack that I figured out, is literally 90% of the time, the daily bias will be in this direction, right? So we don't need to get on the 4-hour chart, you know, or the weekly chart or daily chart. This alone, right, this trend on the 15-minute chart is enough for us to have, you know, the bias right 9 times out of 10. So now that we've got the overall trend of the market, right, that we know we're bullish, key thing is we only want to look for longs, right? We only want to look to buy. And this right here makes our life so much more easier, right? We don't have to guess, you know, do we take a bearish fair value gap or a bullish fair value gap? So we know we're bullish on the 15-minute chart. What I also like to see is a liquidity sweep. So let me just zoom out a bit. Now, what a liquidity sweep is, it's literally just a stop run, right? So don't let the, you know, the fancy names or terminology confuse you. And someone in the comments was, you know, almost like having a go at me, right? They were like, oh, you know, what's the difference between this and a liquidity purge, a liquidity grab? They're all the exact same things, right? Some people will refer to it differently, but all it is a stop run, right? It's a fake move in the opposite direction of the overall bias. So if we know we're bullish, right, what a liquidity sweep really is can you see how price is shot up, it comes down, it just takes out this low, and if I zoom out, can you see this low here, right? This low here, where there would be stop loss orders. Price comes down, it takes out this low, and then shoots off, right? So let me make this a bit more clearer. Let's just zoom in on the charts like this, right? So remember, we're on the S&P here, and this will work on any markets. I'm just showing you on the S&P because Forex has been very choppy lately. So at this major low here, we have liquidity or stop loss orders, whatever you want to call it. Now, can you see how price wicks down like this, takes out this low here and this low here? Anyone who had their stop loss orders here had their stops taken, raided, purged, whatever you want to call it. Smart money, buying, and then they shoot price off, right? You'll see this over and over and over again. Once you've got the higher time frame direction or the overall direction of the market, you will always see a liquidity sweep before the major move. And if you don't believe me, you can do two things. You can either go through the charts, which you probably should do, or if you're a bit lazy, go look in the comment section, right? You will see this over and over and over again. Higher time frame trend or overall market trend, liquidity sweep on the lower time frames, and then an entry. That is all you need to make money, right? So now we have our liquidity sweep, right? Our fake move, and you can tell it's a fake move, right? And this is something for your notes here. Can you see this wick? See how this wick pokes down? It takes out anyone with their stop loss orders around this level, right, just below this low. It wicks down like this, and it instantly shoots off in the opposite direction, all the way up here, and then continues off, right? That right there is a liquidity sweep. So, you know, I did say to you at the beginning of the video that you don't have to trade the 15-minute chart, but you want to do the analysis if you're a day trader on the 15-minute chart. And similarly, you know, if you're a swing trader, you want to do the same thing on the 4-hour chart. But this is the strategy that I used, right? So I'd use the 15-minute chart for the trend, for a liquidity sweep, and then I'd get onto the 5-minute or even the 1-minute chart for my entry. But I'm just going to show you it on the 5-minute chart, right? So if we go on the 5-minute chart, this right here, this line, this blue line is on liquidity sweep. So let's just bring it all the way over here. Now, what I like to see, which makes it a bit clearer, what I like to see, and I always say this, because a lot of people ask me, like, hey, Atif, you know, how do I know it's actually a liquidity sweep? Like, how do I actually know it's a fake move, right? What I always say is to wait for a fair value gap to form in the overall direction of the market, right? Now, if you remember, you know, a stop run is going to be in the opposite direction of the overall market, and the 15-minute trend is bullish. So what that means is we're just going to look for a bullish fair value gap to form, right? And again, sum up for your notes, because we have a little fair value gap here, and we also have a big fair value gap here. You know, if you're ever asking, hey, which fair value gap do I take? Always take the lowest fair value gap when bullish. Always take the highest fair value gap when you're bearish, right? That right there will make you so much money. It's insane. It's insane. So this right here is the lowest fair value gap that you're going to mark out. Lowest fair value gap, like this. Look at that, right? Almost beautiful. I mean, that's almost perfect how it fills up, right? It's almost algorithmic. So that right there can be your high probability entry, right? On the fair value gap. Now, some people ask me, they say, hey, Atif, you know, I don't really like a fair value gap. Can I enter on a different entry pattern? Yes, you can. Like for me, I do a Fibonacci retracement just because it makes my life easier. But you know, if you're starting out with liquidity sweeps, the easiest way to trust it is to wait for a fair value gap and enter on that fair value gap. So what that would look like is simply entering here on the fair value gap. And this is where it gets really important, right? Stop loss always at the liquidity sweep low or high, right? So always at the stop run, because the whole reason we wait for a stop run is so we can put our stop loss in a safe place. There's no point putting your, you know, your stop here or here. We always put it fixed at this low. And if you want a better entry, get onto the 1-minute chart and maybe you'll find an entry like this, right? But in this case, you don't, right? Do you? So this is what you're going to do. Stop loss always fixed here. And for take profit, this is where it gets exciting, right? So even if you have a wide stop loss, you can still get a good risk to reward ratio because you're with the overall trend and you've got liquidity sweep. And all of the most explosive moves in the markets always be after the liquidity sweep, right? And you'll see that time and time again in your charts, right? So let's zoom out. For our take profit, I mean, you can target 2-to-1, right? If you really want to, but for me, minimum, absolute minimum, I'm going to target a 3-to-1, right? And for those who don't know, I always target at least a fixed free risk to reward ratio. Now, I know some of you probably shouldn't do this, but you really want to pass a prop firm, or you want like large risk to reward ratios. What you can do, zoom out, look for obvious liquidity. So you've got liquidity here, right, at this high here, which probably be previous day's high, or daily high, whatever you want to call it. That's an easy target, right? Look at that, 5.5 risk to reward ratio with a decent sized stop loss, right? Decent sized stop loss. So this is why I say to guys, like, look, listen, and girls too, right? You don't need to have a really tight stop loss. You just need to get the direction right and wait for liquidity sweep. Once you've got those two, you can make all the money in the world, right? Just look how explosive this move is, right? We chop for ages. We have our fake move. We have our, let me just make this clear. We have our fake move, which is this. We have our second retracement. This lets all the smart money traders, those in the know, buy the SMT, and then price explodes off and takes out liquidity. So you can target this high here. You can target this high. all the way up here, or you can target list high all the way up here. Right now, remember, the higher the risk reward ratio, the lower the probability, generally the lower the probability, and also the longer you're gonna have to hold on, right? So if you trade, let's say Apex or Top Step, so if you're a futures trader, you're gonna have to close your position, so you don't want to do this. But if you're like me, I used to trade CFDs and futures, right? So if you are, you can hold on for as long as you want. Okay, so for this model, all we need is the 15-minute chart. Now, the first thing you're gonna do when you get on the charts is you're gonna zoom out and you're gonna look for the overall trend on the 15-minute chart. Because I'll tell you what, if you do this 9 times out of 10, you will get the daily bias, right? 9 times out of 10, you will get the daily bias. So what we're gonna do is we're gonna get on the 15-minute chart and look for the overall trend. Now, hopefully, it's really obvious, right, what price is doing. Really obvious what direction price wants to go in, right? Really obvious. Bearish. No, we want to sell the rallies and just ride price down, right? That right there gives us our trend, right? That gives us our trend. And what we want to do is we want to trade with the trend, right? We don't want to do anything fancy. And just by trading with the trend, your win rate will literally double instantly, right? Instantly. It's what happened to me. So here we go. So we've got our trend. We're only going to look for shorts because we're bearish overall on the 15-minute chart, right? And the good thing about the 15-minute chart is this is probably a few weeks of price action, right? Just zooming out. So here we are only bearish and we only want to look for shorts. Now, before we can get into our position, we need to wait for something called a liquidity sweep, right? We need a high probability entry that we can trust and that we can rely on, right? So it's not good enough just to sell, any fair value gap like this, right? Because what will happen is price will come up, it will hit your stop loss and then go straight to take profit. That happens to me all the time. So the way to counter this and what smart traders do and what smart money traders do is they wait for something called a liquidity sweep, which is simply just a stop run, right? That's all it is a stop run. And because we're bearish, we want to see a stop run, right? Against some sort of high, right? Because lots of people are shorting, they're trailing their stop loss, at this high, this high, this high, this high. All we need to see is some sort of old high taken out and then price to drop in the opposite direction. So what that looks like is we want to see this. We want to see price come down, price to come up, just enough to take out an old high where anyone would have their stop loss orders, then drop, give us our retracement here on a fair value gap, order block, optimal trade entry, whatever you like. And then we want to ride price down to either the next liquidity pool or just a 3-to-1 or whatever your take profit usually is. That's what we want to see. Now, can you see this little pattern, this little entry pattern, anywhere in price action around here? Right now, I'm literally marking it out for you, but if you just look a bit carefully here, see this high here, you see this wick. This is so characteristic of a liquidity sweep, right? It's always like a little wick that just pokes through, takes out stop loss orders, and then drops massively in the opposite direction, right? So we've got some old high here. Lots of traders have their stop loss orders here because they're hoping that price is just going to drop and take out this low here and just drop down, right? What really happens is price comes up. Just look at this candlestick here. This wick pokes through, takes out anyone who was short here, then drops, gives us our high probability retracement. Now, I'll explain that in more detail about the actual retracement, and then dropped massively. I guarantee you, if you go for your charts and you look at any massive move in one direction or the other, there will always be a liquidity sweep, right? So now that we've got our liquidity sweep, which is this wick here, this wick that pokes up and takes out these stop loss orders, all we need now is a high probability entry. Now, what I say to my students is whenever there's a liquidity sweep, and if you're not sure, wait for a fair value gap to form, because fair value gaps, it's almost smart money literally screaming at you that this was a fake move, right? Look at this. This wick comes up, takes out this old high, and a massive aggressive fair value gap that's bearish with the overall trend, which we just discussed a few minutes ago. On the 15-minute chart, right? Not the 1-minute chart, the 15-minute chart, a major significant time frame. All day traders are looking at this time frame, right? All day traders. So what you're going to do is once you've got your liquidity sweep and you've got a bearish fair value gap that's in the trend direction, is you look for your entries. Now you can either, I'll show you a few entries right now. The entry at this point doesn't really matter. You can take a really easy, safe entry just by using the fair value gap itself. Now, I always say this, when you have a liquidity sweep, and this is so important, make sure you write this down. When you've got a liquidity sweep, you have to have your stop loss at the high or low that caused the liquidity sweep, right? There is no point waiting for a stop run, right? No point waiting for this high to take out this old high if you're going to put your stop here, right? There is no point in doing that. The only reason we wait for a liquidity sweep is so we can put our stop loss in a safe area, right? I hope you really understand that. That's the only reason we wait for it, is so we know, okay, if I put my stop loss here, right, at this high, very, very unlikely that price can come all the way up and take out my stop loss because it already did that. Right? Very important that. So your stop loss is essentially fixed at this high here. Now, if you want to get onto the lower time frames and finesse your entry, by all means do it, but never ever ever move your stop loss tighter. Never ever do that. Not when you've got a liquidity sweeps. Now for take profit, me personally, I target a 3-to-1. So let me just mark this out, right? Like that, right? So this is my 3-to-1. This is what I target. If you zoom out, easy liquidity here, right? So it's just a bit extra, but you could just target this liquidity as simple as possible, right? Easy 2.5 risk to reward ratio with a big wide stop loss. Now I'm going to show you. Let's just remove this. Let's go and not finesse the entries, but let's go and refine the entries, because right now we're on the 15-minute chart. Now, as long as you've got the 15-minute, let's just zoom out, right? As long as you've got the 15-minute trend and you've got a 15-minute liquidity sweep, you can get on the lower time frames at that point and look for your entry, right? So here's our liquidity sweep. Let's get onto the lower time frames and look for an even better entry. Okay, so here we are on the 5-minute chart, and if you just look at price action, right? This was the old high. Here's the little wick on the 15-minute chart that pokes up, takes out the high, price drops, and this was our retracement, right? And we entered on a fair value gap that was really big and a really wide stop loss, and then price drops to take profit, right? So if you wanted to finesse your entry, and I keep saying finesse, but it's more about refining your entry. What you're going to do is you're going to look for a fair value gap on the lower time frame. Now there's multiple fair value gaps here. So there's a tiny one here, one here, one here. This is really important now, so make sure you write this down too. When you are bearish, you want to take the highest fair value gap that there is, right? So you want to take the highest one here. And when you're bullish, you want to take the lowest fair value gap. So you take this one here. Now, obviously, from what, all the technical analysis we've done, we are bearish and only looking for shorts, right? So if you're bearish and you're only looking for shorts, you are going to take the highest fair value gap, right? You're not going to take the lowest, you're going to take the highest fair value gap. So let's mark this out. It's a bit more clearer. You're going to take this one here because it's the highest fair value gap. That right there will make you so much more money. It's insane, right? So much more money. It's insane. So this is your entry. Stop at the high. Always remember, always fix at the liquidity sweep high, and then take profit. For me personally, I'm going to target at least a 3-to-1. At least a 3-to-1. But if we zoom out, where's that old low? Sorry, here's the old low. Let me just mark this out for you. Old low. That's literally beautiful, isn't it? Textbook, right? 4-to-1, easy 4-to-1, and you can refine this entry even further, right? So you can take this order block here, so the last up close candle before the down move. So what that would look like is you'd have your entry like that, and you just get tagged in for a beautiful and almost a 7-to-1, absolutely beautiful trade. But key thing is 15-minute trend, 15-minute liquidity sweep, and then high probability entry, because the reality is any entry after a liquidity sweep is super high probability. So okay, so for this model, we only need 3 things. We need the trend, we need liquidity, and then we need a simple Fibonacci retracement or optimal trade entry, right, for our entry pattern. Now, we're only going to use the 4-hour chart for this model. We don't need to use daily chart or the weekly chart, right? I'm keeping it as simple as possible, and this is what I do on a day-to-day basis, and literally with so many different setups. I think I've got at least 30 pairs on my watch list, and crypto too, so maybe like 40. And you'll see the setup over and over and over again. So what you want to do is, first of all, you want to zoom out on the 4-hour chart, and you want to ask yourself, what's the overall trend of this market, right? And there's 3 things for a trend. Most people don't understand this. There's 3 different types of trends. There's the first one, which is a simple bullish trend. There's the second one, like this, which is a simple bearish trend. Right, and then there's the third one, which is just consolidation, right, like this, consolidating like that, right? Now, hopefully, it's pretty clear that we are bearish, right? Ever since this point, literally July 2024, we've been bearish. Now, we've had a bit of consolidation here, but we're not trading this. Again, consolidates a bit, but where is price actually going, right? It's dropping, it's giving us retracement, and what we want to do is we just want to ride price down to lows here, here, and here. And even this low here, where there's going to be lots of liquidity, which is simply just stop loss orders. So let's just clean this chart and let's zoom in. So the first thing we've got is our trend. We know we're bearish, right? So what that means is we're only going to look for shorts. We're not going to do anything fancy. And to be honest, if you're trading against the trend as a swing trader on the 4-hour chart, you're going to get punished. You're going to get punished, and you're going to lose a lot of trades. And I think it's almost impossible to become profitable if you're trading against the trend on the higher time frames, right? If you're scalping on the 1-minute chart, you can dance around on the lower time frames, but on the higher time frames, this is where the big boys trade, right? This is where the big banks are trading. you can't fuck about on these time frames, right? So here we go. So we've got our trend. What we need to do now is we need to ask ourselves, where is price likely to go, right? And for those who don't know, price only moves for stop loss orders or what we call liquidity, right? The same thing. It moves for where the money is in the market, because those who are moving billions, JP Morgan, Goldman Sachs, Barclays, HSBC, they can only get in and out of their positions at major highs and major lows on the 4-hour chart, the daily chart, the weekly chart, right? I.e., where would people have their stop loss orders? So think support and resistance, right? Where would people have their stop loss orders? And liquidity gives us our target, right? This is super important because not many people understand this. Liquidity isn't an entry pattern. It's not some sort of technique. It's just, it's the way the markets move. It's a concept, right? It's a theory in the markets, right? It gives you the direction of the market, right? Once you've got the direction and you've got your target, you're 90% of the way there. All you need is a simple entry pattern. I'll show you a simple entry pattern afterwards. But because we're bearish, right? Remember, we're bearish because of the trend. We're not going to look for this high here or even this high here, right? We're not going to say, oh, well, Atif, well, isn't there stop loss, orders at this high and this high? Yes, there is. But the trend, the 4-hour trend is bearish, right? So what we've got to ask ourselves is where is, at this point here, where's the next major lows that have liquidity at them, right? Not the highs, because we're bearish, right? We're bearish, so if we are bearish, what's price going to do? It's going to go down. It can go for this low. You might be thinking, oh, there's lots of liquidity at this low. Yeah, there can be, but this low here, I like a lot because it's been here for a while. And in general, this is a general rule of thumb. The longer a low's been intact, so the longer the low's been there, the more stop loss orders there are there because people feel confident, right? They feel confident. This is you got to think, this only formed, relative to this bit of price action. This low here only formed maybe like 2 days ago, where this has been here for a few weeks, right? So it's a lot more important, especially these lows here, right? So what that really means is for our target, this price is likely to go for this low here, right? This low here where there's lots of liquidity, right? Liquidity, which is simply stop loss orders or money, right? Smart money can only get in and out of their positions at major highs and major lows. So this right here, and even this low and this low, is going to be our target. Now that we've got our trend, which is bearish, and we've got our target, all we need now is a simple entry pattern. Right? A simple entry pattern. And for me, the entry pattern that I like the most is a simple optimal trade entry, which is just a Fibonacci retracement, right? It's nothing fancy. Now, people are going to ask me like, hey, should I put it from this high or this high here? For me, whenever I'm in doubt, I always put my Fibonacci from the highest high to the lowest low, right? If you're ever unsure, right, because a lot of people can think, should I put it on this high here, like this, or should I put it on this high here? If you're ever unsure, put it at the highest high, right? Similarly, when you're bullish, put it at the lowest low. When in doubt, zoom out, right? When in doubt, don't put the Fibonacci super tight, right? Go out. So for me, I'm going to put the Fibonacci here. And if we just remove the Fibonacci, another thing, and this is some of your notes right here, can you see this fair value gap? Never, ever, ever put your stop loss right next to a fair value gap, right? Really important that you want to write that down. Never put your stop loss at, right next to a fair value gap, because let's just imagine you did this. Let's just imagine you went short at this order block like this, and you put your stop at this high and you were going to target this low. Right. Let's say this is your entry. It's very likely that price is going to come up, take out your stop loss here, and then hit this fair value gap, even this order block, and then drop, right? So really important really important. Never put your stop loss when there's a fair value gap right next to it, because you'll see price hit it over and over and over again. So what you're going to do instead is you're going to clear this up. You're going to put the Fibonacci from the high to the low. So let's just zoom out a bit. Fibonacci from the high, this high here, to the low, like this. Now, me personally, I like to enter, let me just show you my settings. Right, so make sure you pause the video. This level right here, 0.705 level, that's what I like to enter on. There is no magic in the Fibonacci. Fibonacci is not moving price. The only thing that moves price is liquidity, right? It's really important. This just gives me an easy entry pattern, so I don't have to guess, which fair value gap, which order block do I take? Oh, this fair value gap's too big, my stop loss is too big. It's the same thing over and over again. And you can take the 0.7 level if you want, but for me, ever since I started using Fibonacci, this has just been my setting, so it's just stuck, right? So just copy me, right? Just copy me and just do what I do, right? So it's just easier. And yeah, what you're going to do is you're going to enter on the 0.705 level, like this. Your stop's going to be at this high here, and you're going to target a 3 to 1, or you can target this liquidity if you really want to, right, for 3.2. doesn't really matter. Now, some people might be asking, hey, Atif, do I need a liquidity sweep? No, you do not. This is really important now. If you don't know what a liquidity sweep is, great, great, right? If you want to be a swing trader and you don't know what a liquidity sweep is, you're probably at an advantage, right? But if you do know what a liquidity sweep is, when you're in the higher time frames, there are liquidity sweeps, but there's a lot less liquidity sweeps than there are when you're, day trading and scalping, which is another reason why I really like swing trading, because it's so easy. Because the reality is, this is a major market. All financial markets are major markets. Billions of dollars are being moved in. There isn't much time for price to mess around and take out stop loss orders and then go in the direction, right? You gotta think. The reality is, this is, NZD JPY, the New Zealand dollar against Japanese yen. There is real business that needs to be conducted here. There's central banks that need to do business deals between each other, New Zealand and Japan. They haven't got time to, really fuck about, with liquidity sweeps, messing around on the lower time frames. If price needs to move somewhere to the liquidity where the money's at, it's going to move, and it's going to move quickly. Now, on the lower time frames, will there be liquidity sweeps on the 1 minute, 5 minute? Yeah. But there's not going to be that many on the higher time frames. So if you've got the trend and you've got the liquidity, right, you know where the money's at, you know where the market wants to go for, you've got the trend, you've got your optimal trade entry, you can make money with that, right? And in fact, that's probably the highest probability setup. If if you're waiting for liquidity sweep, you're going to be waiting for years. Yeah, you're going to be waiting all day for it, right? And you're not going to find any setup. So you don't need a liquidity sweep when you're on the 4-hour chart and above, right? Now, if you get a liquidity sweep, it's going to add to probability, but you don't need it. You do not need it. But if you're day trading, if you're below the 4-hour chart, you need it, right? You need it to become profitable. So really important there. Yeah, so you're going to set up your limit order, enter here, stop loss at this high, take profit either at this liquidity low here or a 3-to-1, or if you really want to, it can be all the way down here, right? But I'm just going to target, for me personally, I just target a 3-to-1. So let's just play price action, right? Like this, right? And then there we go. There we go. It takes out all these lows. So if you really wanted to, that could be your entry, and that could be your take profit. But and again, look, you'll notice, right? Look, what does price do? It wicks up, hits the fair value gap, fills it, hits the order block, and then drops, right? So if you had your stop super tight at this high here, you would have got wicked out only to see price go off in the opposite direction, which would have been very, very, very frustrating. Okay, so for this strategy, we need 3 things. The first thing we need is a liquidity sweep or a stop run. Second thing we need is a fair value gap. And the third thing we need is we need to trade at a key time of day. Now, when you get on the charts, the easiest thing to do is just to have one session that you master, right? It really does not matter what session that you use, because you'll get this model or this setup in every single session if you actually look at carefully, right? So you might need to get onto the 1 minute chart. In this case, we're going to be on the 5 minute chart. Really does not matter. You can replace the 5 minute with whatever time frame you like, right? But here we are on the 5 minute chart, on gold, during Asia, which is a key time of day. And for those who don't know, gold moves really well in Asia, really, really well. I used to trade London, and I'd get onto the charts and I'd see gold had moved so much, and I'd missed the main move in Asia. But anyway, don't worry, right, if you trade Asia, because if you trade Asia, you can get some excellent moves in gold. And what we want to see, right, now that we've got our key time of day, is we want to see a stop run. Now, the most easiest way to see a stop run is to see some sort of large wick, right, some large wick that just pokes up randomly and then drops aggressively in the opposite direction. And then ideally leaves a fair value gap, right? That is the easiest way to spot a stop run. Now, if we look at gold, we've got highs here, 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 right? Around this level here, lots of people are putting their stop loss orders, shorting gold, right? They want to ride gold down to probably these lows or whatever, right? And even if, gold's bearish, I'm not going to determine how it's bearish, right? You can use daily bias. And to be honest, when you're scalping, you do not need to use bias at all, right? You just need to look for a liquidity sweep and a fair value gap. But can you see how this wick just aggressively, instantly goes all the way up, takes out anyone who had their stop loss orders, and then drops off massively, right? Look at this. Look at this wick here. This is the wick that's a liquidity sweep. Look at this. It goes instantly up, takes out all the stop loss orders around this high, drops aggressively, gives smart money that high probability retracement, high probability entry, and then drops off massively, right? You'll see this out every single day. It's insane. And if you don't believe me, go look in the comments, right? So many traders have become profitable using this. This is what I use literally to retire my mum, right? To retire my whole family on this exact setup here. Liquidity sweep, fair value gap, entry, right? And lots of people ask me like, hey Steve, how do I know it's really a liquidity sweep? The easiest way to understand if it's a liquidity sweep is obviously first wait for like some, large wick that takes out a stop loss, and then wait for a fair value gap to form in the opposite direction, right? Only once this fair value gap forms like this, like that, right? Let me just make this a bit more clear. Only once this forms do I know that it's a liquidity sweep, right? Or to be honest, only at that point is it a high probability liquidity sweep, right? You don't need a fair value gap, and with experience, you won't need it. But if you're a new trader or if you're unprofitable, make sure you wait for a fair value gap, because the fair value gap is essentially smart money telling you, screaming at you, saying, hey, look, this is a fake move. This is a fake move, because the only reason this fair value gap's here is just to allow smart money traders to get back into the move, right? So once you see that fair value gap, that is smart money telling you at a key time of day that was a liquidity sweep, that was a fake move, only designed to take out stop loss orders. They're literally telling you, hey, look, we're all going to enter here. Come join us. Come join us, right? So once this fair value gap forms, then and only then am I confident that this is a liquidity sweep, right? This is a fake move only designed to take out stop loss orders. Now, you might hear some people talk about turtle soups. Let me just explain that very quickly. Right? You might hear some people talk about turtle soup. And what that is you see how price comes up? At this point right here, when price is taking out these stop loss orders, price can continue all the way up. It can take out this high, and it can go up and up and up, right? Like, who knows what could happen? I don't know what could happen, right? So there are traders who are called turtle soup traders who will start to sell as soon as price takes out these highs here, hoping that price drops massively. If it does drop massively, they'll make a shit ton of money. If it doesn't, they'll get fucked, right? That's just the way it is, right? Their stop loss will get hit instantly, and it's very low probability, right? So when you wait for confirmation, right, this is our liquidity sweep, and then we've got the fair value gap, which is our confirmation, and then you enter on that confirmation. That is a really, really high probability setup. Okay, so how do we actually make money with this model, right? It's the only thing we care about. So we've got our liquidity sweep, which is just a stop run, so don't let the terminology confuse you. It's the logic that matters, right? And just look at this. Look how obvious this is. Look at this large wick, shoots up, and then instantly drops down, right? Clear, obvious liquidity sweep, and we've got our fair value gap. If you want to, you can get on the lower time frames and look for a better fair value gap. And by better, I mean a higher fair value gap. And just to answer a few questions, some people might ask me, hey, how come we're not entering on this fair value gap? This is something for your notes, right? So make sure you pay attention to this. When you're bearish, you always want to take the highest fair value gap. And when you're bullish, you always want to take the lowest fair value gap. So because we're bearish, we're only going to look for the highest fair value gap. We're not going to look for this one here. We're only going to look for this one here. And then for your entry, you're going to enter on that fair value gap. Stop loss is fixed at this high here. Super important, right? This is a liquidity sweep high. The only reason we waited for a liquidity sweep is so we can put our stop loss at a safe area, right? Because price came up, it took out all these stop loss orders, dropped massively. Very, very, very unlikely that price is going to come all the way up and take out your stop loss and then drop off again, because that's what price has already done right here, right? That's what price has done right here. The only reason this came up, only reason price came up was just to take out stop loss orders. So very, very unlikely that that's what's going to happen. What's more likely is that price is going to come up to this fair value gap, maybe touch the order block, and then drop off massively, right? That's what's likely to happen. So your stop is fixed at this high because it's the highest probability of your stop loss not getting hit. Now, I'm not going to get onto the 1 minute chart or even the second chart. If you do, you could probably find like a little, you probably find like a little fair value gap here, right? Use your imagination. That's almost beautiful, that. But you might find a fair value gap on the 1 minute chart that you can enter on, right? The highest bearish fair value gap on the 1 minute chart. Get a tight entry, but your stop loss is always fixed at this high, right? So if you want, a tight entry, tight stop loss, you're gonna have to get onto the 1 minute chart, and then find like another fair value gap, or even the order block if you really want to. But for this model, I'm just gonna use the 5 minute chart, and we're just gonna look at the 5 minute fair value gap. Stop loss fixed at the high. What you're gonna do is you're gonna target at least a 2 to 1, minimum 2 to 1, minimum 2 to 1. Just because you can get it so easily. Why would you ever aim for a 1 to 1? For me personally, for those who know, I target a 3 to 1, like a fixed 3 to 1. So like this. Now you can target these lows if you really wanted to. For me, 3 to 1 is what I love. And because we're in Asia, let me just make this a bit more clearer. Because we're in Asia, so here's our liquidity sweep. Let's make this a bit smaller. Here's your liquidity sweep. Right here, liquidity sweep in Asia. Drops, fair value gap, high probability entry, price drops massively. It almost takes out this low, and then it goes up just because it's London. And if you look really carefully, this is something for your notes actually, or something for your, your own independent study. You go really carefully here. See this high? Price just takes out this high here, right? And then drops off massively. Now, if you get onto the 1 minute chart, you'll see the same setup here, right? This wick will take out this high here, it will drop, then it'll give you a fair value gap. This exact same setup will be on the 1 minute chart here. And you can almost see that, right? Because there's like 2 or 3 candles on the 5 minute chart, which will be about 15 candles on the 1 minute chart. But anyway, doesn't really matter. Point is, you get your take profit here early London, and you'll see this setup over and over and over again. And like I said, I'm not going to do it in this video because it'd be too long, but if you get on the 1 minute chart, you'll see the exact same setup on the 1 minute chart, and then you can ride price down, right? It'll probably look something like this, right? Something like this. You get your 3 to 1. And if you really want to, you can ride price down. Right? And if you look again in New York, this candlestick here, let me just delete this stuff here. This big candlestick here takes out London's high here, and then starts to drop. So if you get on the 1 minute chart again, you'll start to see a fair value gap form, bearish fair value gap, enter on the bearish fair value gap, ride price down, right? You'll see this setup over and over and over again. But if you're starting out 5 minute chart, you'll get, it's easy to see on the 5 minute chart, and with more experience, or if you want, a tight stop loss, you can get down onto the 1 minute chart. Okay, so the first step in this process is we identify liquidity on the higher time frames. Now, when I say higher time frame, I literally mean the daily or 4 hour chart. Now, you can use either, but in this example, I'm going to use a daily chart just because it makes it, it's so obvious where the actual liquidity pool is. Now, liquidity, for those who don't know, it's simply major highs and major lows where there would be stop loss orders, right? Because the only reason, and it's super important, the only reason these markets move is for stop loss orders, right? It only moves for where the money is at. And to be honest, if that's the only thing you take away from this video, you've literally changed your entire perception of trading, because it's not indicators, it's not VWAP, it's only for money, right? Those who have billions need to get in and out of their positions, and the only way they can do that is at major highs and major lows where there's lots of stop loss orders, right? Where there's billions of dollars worth of orders resting at these stop loss orders. Now, you'll see a million different ways of identifying liquidity, but the simplest and easiest way that I literally give my private students is to get on the charts, right? So let's imagine you're on the charts at this point here, and then you just ask yourself which major high or low is price likely to go for, right? Which major high or low here is price most likely to go for, right? So if you're on the charts at this point right here, and then you click, the daily chart, what high or low is price likely to go for? Is price more likely to do this, continue upwards and take out this high here, maybe even this high here, and then maybe push up to all-time highs? Or is price more likely, right? Is it more likely to come all the way down and take out these lows here, right? Which one's more likely? Now, hopefully it's pretty obvious, and it should be really fucking obvious, right? Because I've literally marked out the liquidity or stop loss orders, right? We're going to go for this high, right? Price is literally right at this high. We've been bullish, and very, very unlikely that price can come all the way down and take out this low, right? Very, very unlikely. So what does this actually mean, right? What does this actually mean? Because we all hear about liquidity, liquidity, liquidity. It's like some buzzword that gets thrown around. What does this actually mean? If price is most likely, or it's very likely to come and take out this high here, what does that mean for us as traders? How do we actually make money from this? What it means, and this is something that you want to write down in your notes, it means that we are bullish and we only want to look for longs, right? Super important. There's no point identifying liquidity here and then, going on the 5 minute chart and then, selling at some random fair value gap. There is no point in doing that. This tells us the direction of the market. We know the highest probability setups are going to be in the direction of the liquidity, right? And this right there, once you've got your liquidity, once you've got your direction, you are literally 95% of the way there. All you need now is a simple entry pattern, and then you can start making money right away. Okay, so for step 2, we want to look for something called a liquidity sweep, right? And this is simply just a stop run. All we want to see is a stop run before we can enter, because, and you've probably seen this so many times, right? The markets do not move, in straight lines like this. You can't just buy the dip randomly and then hope that price goes up, because you will see 9 times out of 10, what actually happens is this, right? What actually happens is price goes up, it comes down, it takes out your stop loss, and then goes straight to take profit. Now, the reason this happened is because, like I said, right at the beginning of the video, these markets only move for stop loss orders, right? Super important that you understand that. These markets are highly, highly manipulated, and they're designed not for me and you to make money, right? We are literally completely irrelevant. Completely irrelevant. It's designed for those who have billions to get in and out of their positions, right? So their algorithms, which trade the lower time frames, are literally coded just to hunt stop loss orders, right? And where you'll find major stop loss orders, or at least on the 5 minute chart, you will find it at lows and highs, right? Major lows and major highs. That's where you will find your stop loss where you'll find stop loss orders, right? Now, can you see anywhere in this bit of price action? I know it's a bit messy, but the reason why, it's actually the weekend for crypto. So crypto tends to be a bit, choppy during the weekends. But anyway, doesn't really matter. This concept here of liquidity works on every single financial market, right? Even the Indian stock market, for the guy who was asking, right? Even on that, it works on literally every stock market. If you see candlesticks like this, liquidity will work, right? If you're trading meme coins, whatever, liquidity will work. It's how all markets move, right? So here we go. Can you see anywhere in this bit of price action, can you see price coming down, taking out some sort of old low where there might be stop loss orders, and then going off, and then coming back down, let's say here, giving you a nice entry, and then shooting off? Can you see that anywhere in price action? Now, I'm saying this rhetorically, right? Because you should be able to see it unless you're blind. I'm literally showing it to you. Can you see how price comes down here, takes out this low here, where there would be stop loss orders? Notice this, right? This is how you know it's a liquidity sweep. Really important here. So make sure you pay attention. This is how you know it's actually a liquidity sweep. Can you see how the candlesticks just slightly go below this old low, just enough to take out stop loss orders, and then quickly and aggressively shoot off in the opposite direction, right? Can you see this? Look how price comes down just enough, just slightly below this low, where there would be stop loss orders, to take out anyone who had their stop loss orders here, because not everyone puts it exactly at this low. They put it around this level here. So price comes down just enough to take out stop loss orders, quickly and aggressively shoots off in the opposite direction. That right there is a liquidity sweep, and you will see that in any market, right? Whatever you like to trade, get on the 5-minute chart and you'll see this. And the key thing with liquidity sweeps is all the explosive moves will always occur once there's been a liquidity sweep. And the reason for that is because it allows smart money, big banks, whoever's got billions and stuff, to actually get into the position, right? Because the reality is these markets aren't going to move unless those in the know, those who have billions are actually in the market, right? They need to actually get into the market, and they can't just, they're not like me and you. They can't just, sell at this, fair value gap and actually get in, right? They're not using fucking trading view, are they? Right? They're moving billions into the market, and the only way they're going to get in is by taking out stop loss orders. And it's nothing personal against you, right? People are like, oh my god, market makers are hunting me. They're not hunting you. They're just hunting whoever's got stop loss orders there, right? So to actually make money in trading, we need to wait for this liquidity sweep. We need to wait for a stop run, right? So once we've got our liquidity sweep, then and only then do we actually look for our entries. Super important there. If you don't have a liquidity sweep, you will not make money. And that was me for 4 years. 4 years of trading. I put so much time, so much effort in it, and I couldn't make any money because, I'd get the direction, right? I understood step 1. I understood step 3, which I'll tell you in, literally a few seconds, right? But I didn't understand step 2, right? What would happen to me is I'd get the direction, right? I knew liquidity was somewhere up here. Price would come down, it would hit my stop loss and shoot right off. And it was the most annoying, frustrating thing in the entire world. So once you've got your liquidity sweep and you've got your overall direction, which we just zoom out, this is our liquidity, right? On the daily chart, which we talked about. We've got our direction, we've got our liquidity sweep, which gives you your edge, right? You don't have an edge unless you've actually got the sweep. Once you've got your sweep, you have your edge. All we need now is a simple entry pattern. Now, there are so many different entry patterns I can give you once we've got our sweep. But the key thing to realize, when you've got a liquidity sweep, is that your stop loss has to be at this low here. There is absolutely no point. Let's just imagine, right? This was an entry. Absolutely no point having this as your entry, right? Your stop all the way up here. Let's say at this fair value gap. There's absolutely no point of doing that, because the whole reason we wait for a liquidity sweep is so we know we can put our stop loss in the safest area possible, where it's highly, highly unlikely that it will get hit. Super important. So if you want to finesse your entry, by all means, you can try and hit this little order block here or whatever, but your stop has to be fixed at this low here, right? So let's go for the fun part, right? Let's actually get some entries going. So right here is a fair value gap, and I always love to see this. So people ask me, my private students mainly ask me this, hey Atif, do I actually need a fair value gap to form for it to be a liquidity sweep? The answer is no, you don't need a fair value gap. But if you're starting out and you're not sure, I would say always wait for a fair value gap, because that, once you've got a fair value gap and a liquidity sweep, it doesn't get higher probability than that, right? That is the highest probability thing that you can get in all of trading. Okay, so for your entry, there's really only 3 entries that I recommend to my private students that I teach them. If you're interested in being a private student, you can check the link, first link in the description. But what I teach them is to look for either a fair value gap, which we just discussed, an order block, which we'll discuss in a minute, or my personal entry, which is an optimal trade entry, simply a Fibonacci retracement. But for the first one, fair value gap, right? And these are the building blocks of every single trading strategy: fair value gaps, order blocks, and optimal trade entries. It does not get simpler than that. But for a fair value gap, what you're going to do is you're going to mark out this fair value gap here, and in the moment price hits it again, that's your entry, right? That is going to be your entry. Now, some people might be like, hey, Atif, let me just mark this up. Hey, Atif, shouldn't have priced shouldn't it have hit it here? Like, it has consolidated a bit. Is that okay? Yeah, it's completely fine as long as the fair value gap is still fresh. Now what fresh actually means, as long as it's not being touched, right? As long as the fair value gap's not being hit, you are good to enter. You are good to enter, right? It's still valid. The only moment it's not valid is when it's been hit like this, right? We don't really want to see it come back down again, right? Not if we're bullish. So you can enter at this fair value gap like this. Stop, remember, like I said before, always fixed at this low here, liquidity sweep low. And then for your take profit, you're going to target at least, if you like a 2-to-1, by all means go for it. But come on, bro, let's go. Let's make some money, bro. Let's make 10K a month, right? We're not making, 1K a month. Let's make 10K a month, boys. So here we go. Let's aim for at least a 3-to-1. If you want to, you can aim for, look at this, almost triple highs here, right? Liquidity here, here, and here. But the key thing is we're trading in the overall direction. Now, I'm not going to say go target this liquidity, especially not as a day trader. But, if you're a swing trader and for whatever reason, some swing traders, they like to do their analysis on the higher time frames and then enter on the lower time frames. If you want to, you can do this, right? You can do this. But for me, the most I would ever recommend is just to target liquidity here, which is literally a beautiful, perfect 5 risk to reward ratio like that, right? So let's just remove the fair value gap. For your next entry, we want to use the order block. Now, I'm not going to talk too much about order blocks here because there's videos on the channel discussing order blocks. But what an order block really is, it's the last down close candle before the up move. Now, you've got this little doji candle here, but for me, I like the bodies, right? Because the body of the order block is literally where smart money has been trading. So let's mark out this candle here, and you can just merge the two together, right? It really does not matter. You're going to merge the two together like this, right? This is how you get some of your sniper entries, right? Look at that, minimal drawdown there, right? So what you would do, enter like this. Stop fixed at the low here, fix at this low here, and then for your take profit, you're going to target at least, like I always say, at least a 3-to-1, or you can target these highs here, right? 5.3 risk to reward ratio. But last but not least, is my entry pattern, right? If you're like, hey Atif, what fair value gap do I take? There's a few of them. Which order block? Should this be an order block or that? I would strongly recommend just to use a Fibonacci retracement, right? Get your Fibonacci from the low to the swing high, which is this, or literally even this, but this is the highest high, right, after the sweep, so we don't use this one. The name shouldn't confuse you, right? An optimal trade entry is simply a Fibonacci retracement. What you're going to do, though, is enter at the 0.705 level here. Let me just show you the Fib settings, like this. Right, pause the video. This is the only one that matters, this level here. You're going to enter at this level, and then you're going to target either this high here for an easy bread and butter trade, or 3-to-1. Like this, right? Nice and easy, nice and simple. Now, this, you might think, oh, we get tagged in here and then it chops for a bit and it goes down and then goes out. And yeah, but the reason for this is because it's crypto during the weekend. And to be honest, like if you're a day trader like me, like who gives a shit? Like if you're in it for if you're in the trade for 4 or 5 hours and you make 3K profit per funded account, who cares, right? To be honest, who cares? If you want to finesse your entries, like I said, here's the fair value gap, here's the order block. So choose whichever one works for you, but personally for me, what I use is the optimal trade entry. Now, really important to remember, fair value gaps, order blocks, optimal trade entries, completely and utterly useless if you don't have liquidity and the liquidity sweep, right? They are completely useless. So make sure you've got liquidity first for your direction, make sure you have a liquidity sweep, and once you've got those two, you can look for your simple entry. And if you're interested in being a private student, you can check the link in the comments down below.
We've got our stop run, our fake liquidity sweep. Now we're looking for our entry. Now for me personally, this is my entry. Full transparency, I just take an optimal trade entry, which is literally a Fibonacci retracement, because I'm going to keep saying this, the entry pattern is the least important thing. If you've got liquidity, or if you've got liquidity on the higher time frames that we have here, and you've got your liquidity sweep, the entry pattern does not matter. Any sort of fair value gap, order block, indicator, even VWAP, you know, optimal trade entry, Fibonacci retracement, all of them are high probability. As long as you've got liquidity on the higher time frames, you're trading in that direction, and you've got your liquidity sweep. So we're gonna enter 0.705 level, stop loss at the low, like this. And for me personally, I just target a free risk reward ratio, like that, right? Nice, easy trade. You guys got the point in your free risk reward ratio, nice and easy. I did this all the time where I was day trading, when I was scalping, and now I do it when I'm swing trading. This model right here is the money maker. It's the model that took me about 4 years to finally figure out. But yeah, this model is so good. Now, let's just let me just tell you a few things, right? Some people always ask me, they say, hey, you know, should I target all the way up here? No, that's not what we do. We do not target that liquidity unless you think within a day you can hit it. But we don't need to hold on for days and days and days, unless you want to be a swing trader. But we don't need to do that for day trading. All we need is a little slice of the move, right? So free risk reward ratio is more than enough. Now, let's just remove the Fibonacci. Let's say you wanted to enter on the order block, right? So let's just mark out the order block. This right here is your order block, right? What you would do, you'd enter like this, right? Stop loss at the low. Now, I always say this, I don't keep saying this because two reasons why. I guess more people keep joining the channel, which is good. So I'll keep saying this until people understand this. Because this is a liquidity sweep, because price, let me make this very clear. Because price has come out and taken out these stop loss orders, right? This is a fake move. This is a fake move designed only to take out stop loss orders. Very, very unlikely price going to come down, take out this move here, which was just a fake move designed to take out stop loss orders. Very, very unlikely that price is going to do that and then quickly continue on with a direction. Right? If price does come down here, it's probably because we're wrong, right, with the direction, and there's going to be a retracement on the like higher time frames or something. But doesn't matter, right? Entry pattern doesn't matter. So let's just play price action. Let's just assume you want to enter on the order block, and then you're going to target, let's say free risk to reward ratio, right, like this, and then we're just going to enter the trade, right? Enter the trade, get tagged in, and then let price do its thing. Let price do its thing. Lots of people just like, they start taking partials, they start moving the stop to break even. Just let price do its thing, right? I literally closed the chart. I set my take profit and leave, right? There we go, we hit it. So this is a late London trade, and then you hold on into like early New York, and then you hit take profit. Right, key thing is, once you've got all this analysis, literally, and you're in the trade, just close the charts and move on with your life. No one gets paid to watch their P&L here, right? Because lots of new traders, especially, this was me, see how price is like kind of chopping up and down. You might be up like 1K and then price, goes back down to like $500. Like, you don't want to be doing that. You don't want to be doing that because it's kind of hard, especially here, right? Lots of people would panic. Let me see it. See here how we just about missed take profit. They go, oh no, what if it reverses like that, right? Like that. Like, you don't want to be that. I just settle my limit orders and I move on with my life. Like, there's very rarely, maybe like 1 in 20 trades, where price will come all the way up here and then reverse down like that, right? And then someone will go, oh, you could have put your stop to break even. Like, okay, fine, whatever, but really does not matter. Once you do this model and once you backtest it, you'll have so much confidence in yourself and in the model, you won't need to like babysit and stuff. But just sitting through this for like 2 hours, 3 hours, I don't know how long this is, maybe like 2 hours, right? Like 2 hours, there's no point in it. There's no point in it whatsoever. I've learned from trading, right? To set up your limit orders, get tagged in. As soon as you're tagged in, right, you've got your stop loss in there, your take profit in there, let it do its thing. Let it do its thing. And then there are people, some people will be hating on you like, oh, well, that shows you not got confidence. No, it shows you that you're smart, right? Go to the gym, go read a book, go do anything else apart from, looking at the trade, because you're just going to panic, right? I used to panic, and, I'm going to give up P&L and stuff. But yeah, that's just a little bit of, I guess big brother advice for like managing your trades and stuff. And for those who are asking, I don't move my stock. I don't take partials at like, a 1 risk reward ratio or something. I don't take partials at all. I just let it hit my take profit. Now, once I'm up, this is something, I guess if you really, guys really do care. Once I'm up about 2 risk reward ratio or 2%, I'll move my stock to break even. But this is really important. This is because I'm swing trading now, because I'm too busy to day trade. So this is on the 4-hour chart. So everything's very slow. If you're a day trader, just let it do its thing. Honestly, let it do its thing. If you really want to move your stop to break even at like, let's say when you're up 2%, see here, just set it like an order on like, an alert on like MT4 or whatever you trade, right? Set up an alert, and then once it hits this level, you'll get like a notification on your phone, and then quickly move your stop to break even, right? That's what I would say. Like, close the charts and then set up, I guess like an alert or wherever you put your price to break even. But literally, that's all you guys need to be a profitable trader. As long as this is so important, as long as you guys have got higher time frame liquidity, right, on the daily or 4-hour chart, and then you combine it with a lower time frame liquidity sweep that we have here, right? Like we have here. So here's our liquidity sweep, lower time frame liquidity sweep. Price moves up in the higher time frame direction, showing us that we are bullish. Then you enter any sort of retracement, ride price up. That is the highest probability trading model. It makes so much money. It's so easy. It works on all time frames, by the way. This will work on the 1 minute chart, and it works all the way on the 4-hour chart. Okay, so for London session, what you want to do is you want to look between 2 a.m. Eastern all the way up until 5 a.m. Eastern, right? Always in Eastern New York time, always in this time. So 2 a.m. till 5 a.m. is London session. Now, London session will always do this. What it will do is it will accumulate around 2 a.m. It will consolidate a bit, gather stop loss orders. Then a fake move will happen, right? A fake move will happen, a liquidity sweep designed just to take out liquidity, designed just to take out lows. Then price will move in the real direction, give you lots of fair value gaps like this. Then it will retrace and then continue on, right? This is what London does consistently, day in, day out, right? So let me just do that again to make it super clear. So around 2 a.m. Eastern, so let me just mark it out around here. Price will start to consolidate like this, right? It will start to consolidate. The reason it does that is just to accumulate orders, right? Just to get people buying and selling, just to generate or engineer liquidity. Then what price will do is it will come down and it will take out all these lows here where liquidity was generated. It will move off in the real direction. It will retrace down here. And then we want to enter on a fair value gap or even an order block, some sort of entry here. And then we want to ride price up, right? That is what London will do day in, day out. And if you don't believe me, go look at your charts. Go look at your charts. 9 times out of 10, you will see this. Accumulation, manipulation, distribution, whatever you want to call it. This is what happens, right? So to trade London session, what you're going to do is just honestly ignore like any price action before 2 a.m. I know, it's going to be, you're going to miss some entries, but just ignore it. Like your time is much better off spent just looking at price action from 2 a.m. onwards and then wait for liquidity sweep on the 1 minute or 5 minute chart. You can do it on the 15-minute chart, but if you do use the 15-minute chart, you're going to get a lot less entry. But here we go. So run the 1 minute chart on gold and you can do this on any pair. And obviously GBP USD, EURUSD and gold are probably going to be the best of London. And, even Swiss franc too. But what you're going to do, wait for the liquidity sweep that we have here. Wait for price to quickly and aggressively move in the opposite direction. Wait for fair value gaps to form, because the fair value gap, right after the liquidity sweep, that tells us where price is actually going to go, right? That tells us that we have a liquidity sweep. Right here, I'm not buying price down here because I have no idea where price is going to go. It could, price could continue going all the way down here, right? But because price shoots off massively and aggressively, leaves fair value gaps, that tells me I'm on the right side of the market, right? That tells me that's just a fake move. Now, you'll see there's a fair value gap here. Let me just mark this out. There's a fair value gap here, but it's essentially filled already. Now, what I mean by that is, you see how the wicks come down, it's filled it, and it's instantly shot off massively, right? Very unlikely, especially if we're bullish, that price, after doing the liquidity sweep, is going to come all the way down here and give us like an insane risk to reward ratio, right? Very, very unlikely, because the real entry was here. Now, if you got the entry, by fair play and stuff, but the real easiest entry, I would say, that we should all look for is this right here, right? Just take the easy fair value gap that forms here. So let me mark this out for you. Right here, the fair value gap that forms. And just look at this, right? You see this little gap here? Let me just zoom out to make this so clear. Look at like how obvious that is, right? Price just taps down just to take out these stop loss orders here, and it massively and aggressively moves on. Massive, big fair value gaps. That's telling us where smart money actually wants to move the market. Once we've got that, we're just looking for our entries, right? We're looking for our entries. And this is what I do. I was trading London for years and years. I'm in the UK, right? And this is what happens consistently. Now, for stop loss, it's so important. So important. Do not put your stop loss at the fair value gap here, right? Or, at this low here. And I know, this in this instance, you get away with it. But the whole point of London is you want to put your stop loss at the liquidity sweep, low or high, right? If it's bearish, you just flip on its head, right? But you always want to put your stop loss at the liquidity sweep low. I always say this, I'm going to keep saying it until everyone's fucking profitable. It's very unlikely price going to come all the way up, come all the way down, take out this low again, which was just a liquidity sweep. Very, very unlikely price going to do that, take out this low, and then go all the way up like that. Very, very unlikely, right? Now, it can happen. I've seen it happen before. But, very, very unlikely that to happen. That's why we always put our stop loss at this liquidity sweep low. Very safe stop loss here. And then for take profit, personally, I always target through risk to reward ratio, even when I was day trading and scalping. And just because I like it, right? It's a nice, easy risk to reward ratio. You can take a 2-to-1 if you want, right? Nice and easy, but especially if you're on the 1 minute chart, you can get some insane risk to reward ratios. But that is literally how you trade London. Wait, let me just show you again, right? Wait around 2 a.m. Expect to see some sort of accumulation. You might see this before 2 a.m., right? But some sort of accumulation like this. Expect price to do a fake move just to come out and take out some sort of stop loss orders, move off in the real direction, leave lots of fair value gaps, right? Leave lots of fair value gaps here, then enter on one of those fair value gaps, put your stop loss there, and then ride price up, right? That is how you trade London session. And yeah, let me show you how to trade New York session now. Okay, so we're in New York, and New York is 7 a.m. Eastern all the way up until 10 a.m. Eastern. Now, in my experience, after years of trading, this is probably the easiest session because you don't need daily bias. And you don't need daily bias. The bias for New York is almost 9 times out of 10. It's the same bias as London, right? So if you just zoom out, London, it's obviously bullish, right? So for New York, all we're looking for is a continuation. Now, this is what London, this is what New York will always do, right? This is what it'll always do. So let's suppose this is London, right? London's moved up like this. It's bullish. Price will come down. It'll take out some sort of low. It doesn't have to be London's low, but it'll take out some sort of low, and it'll move off in the opposite direction. It will leave some sort of fair value gaps here, some sort of bullish fair value gap. We can enter on any of these entries and then ride price up, right? Notice how we don't have to wait for a market structure shift, right? And I'm a big believer in just ignoring market structure and focusing on liquidity. Now, a market structure shift would be if this, like, let's say this candlestick, the body closed above this high. That would be a bullish market structure shift. You can wait for that if you want, but you're going to miss so many good entries. So many good entries that, yeah, I'm telling you, if you just ditch market structure and focus on liquidity, your win rate will go up massively. But anyway, here we are on New York, right? So New York, any entry between 7 a.m. till 10 a.m. Is great. Even 11 a.m. really, 10 till 11 a.m. But at 7 till 10 a.m. is when you get the golden, I guess, meat of the move. Now, something you need to know, and you must know this for New York, is at 8:30 a.m. Eastern, there's almost always a news announcement. Now, sometimes the news announcements are insane, like CPI, which you avoid, because what you'll see, and you probably see this in your charts, right, is you just have like loads of little candlesticks like this, and then you'll see some massive candlestick where in like one candlestick it does that. So that makes sense. And then it goes back to being normal. What that is, that's like a CPI where it's like a news event. And avoid those sort of things. But right here, we've got, I don't know what news it is. It really does not matter, by the way. Right? The news, like announcement, whatever it is, I do not care about it at all. All we want to see is the price action, because the price action will tell you everything. So right here, and I hope this is really obvious, right, with this massive weight, this is just a liquidity, right? This is a fake move designed just to take out stop loss orders. The only reason price did that, right? I mean, just look at this way. Look how obvious this is. Price wicks down, quickly and aggressively moves off, right? I mean, if you really think about it, quickly and aggressively moves off. And then we want to enter on any sort of retracement, ride price up, right? The same old thing that we always see. Liquidity sweep, massive movement in the opposite direction, and then enter on any sort of entry. Now, this is really important, right? Because right here, we've got, the safest stop loss is going to be around here, right? It's going to be around here. Now, that's a massive stop loss, especially if you're entering on a fair value gap. And you don't have to enter on a fair value gap. This is really important. You don't have to enter on a fair value gap. It's just for new traders, it's really easy to spot. And for me personally, for those who know how I trade, I take like an optimal trade entry. And when I was day trading, right? So I would literally enter at the 0.705 level, like this, right? Like that. Stop loss at the low. And then usually I target a free risk to reward ratio. Like that, right? That's my entry, right? Obviously, I need the liquidity sweep first, right? I don't have a liquidity sweep, I'm not trading. But once I got a liquidity sweep, I will take just an optimal trade entry, Fibonacci retracing. Because I'm confident in the bias. I've seen this so many times. I know this works. But you don't need a fair value gap, because right here, if you've got a fair value gap, you're going to have to put your stop loss here. Let me just show you what I mean, right? You enter here, you have to put your stop loss all the way down here, which is the massive stop loss. What you can do is you can enter on this order block here, right? And I've got a video on order blocks, lots of order block videos. Now, this is quite interesting. There's an order block here, here, and here. So it might be confusing to you about which order block to do. Is it this one? Is it this one? Is it this one? For me, personally, I like how these two red candles are almost together, like that, right? So let me just mark this out. This for me would be my order block, like this whole thing here. And just look at the bodies, man. Look how the bodies almost perfectly respect this. They wick into it and instantly shoot off. That right there, for those who are asking, that right there is respect of an order block. Price taps the order block, quickly and aggressively moves off in the opposite direction. That's when when people say price has respected the order block, it's respected the fair value gap. That's what that means, right? It's tapped it and it's instantly moved off. So right here, I would enter, let's just say if I didn't want to enter the fair value gap, I would enter on this order block here, like this, right? Like that. Now my stop loss would have to be at liquidity sweep low. Yeah, right. Let me just mark this out right here. Has to be at this liquidity sweep low. Now you might be asking, like, what low did it sweep? Like, there's so many lows here that it's just trailed up, trailed up stop losses from. We zoom out, right? So many people are just trailing up their stop losses all the way up here. So any sort of lows that are taken, and that's our liquidity sweep. Now you don't have to be dead, rigid, and with your liquidity sweep, it doesn't have to be, it has to be a perfect swing low. Which low does it have to take out? You just have to look at price action, right? Just look at price action. If you get on the charts, let's say at this point here, and you've seen this massive wick that's only come down to take out stop loss orders, it quickly and aggressively moves off in the opposite direction. And if you zoom out and you know that New York is almost always a continuation of London, right? And London's been massively bullish, it's a safe bet, right? It's a safe bet that any sort of retracement will do. So what you're going to do is, let's say you want to enter on the order block, stop loss at the liquidity sweep low always, and then you're going to target at least a 2-to-1, or what I always do is target a free risk reward ratio, like that, right? Like that. And remember, we're on the 1 minute chart here, so what time is this? It's about 9:37, and then when do we get take profit? So it's literally about 30 minutes in a trade. And if you're risking 1% on a 100k account like I do, that's like 3k per trade, per funded account. Which is a lot of money, boys. A lot of money for half an hour. Yeah, that's my old monthly salary made in half an hour. So, and you can do this exact same thing on the 5 minute chart too, right? So, you know, price is fractal, and what that means is literally forget the time frame, just blur that out. This would be the exact same thing, even on the daily chart. It's the exact same thing over and over again. Price is the same thing. And yeah, so New York, almost always, 9 times out of 10, is a continuation of London. All we want to see is let's say, London's bullish. We want to see a massive bullish movement on London. And then we want to see some sort of liquidity sweep, right? But it doesn't have to be London's low. It can be if you want to wait for it. But any sort of low will do, right? Any sort of, you know, fake move, any sort of large wick that takes out stop loss orders. That's what we want to see. And then we want to see price massively move off in the opposite direction, leave fair value gaps, and then we want to enter on, let's say, a fair value gap, order block, an optimal trade entry, but we want to put our stop loss at the liquidity sweep low, right? A safe stop loss, and then we want to ride price up for a 3 risk reward ratio usually, or a 2 risk reward ratio. Yeah, you guys get the point, right? So for the last session, last but not least, I'm gonna show you how to trade Asia session, and I'm gonna do it all in gold because I like this pair and you guys like it too. So let's get to Asia session. Okay, so for the last session, we have Asia, which is 8 p.m. Eastern time, all the way until midnight, right? So you've got 4 hours for Asia. Now, Asia almost always does this. If we just zoom out, here's our liquidity sweep. What Asia tends to do is, let's suppose we're bullish on the higher time frames, right? So let's say this was London's move, like this. Let's say this was New York's move, where it's, let's say, retraced. It's taken out London's low, and it's gone off like that, right? So it's continued London trend. What Asia tends to do is it tends to be a retracement on the higher time frame. So if you're bullish overall, like we are here, what you can expect Asia to do is have a little bearish retracement, right? Maybe something like that, right? And then for London, what London can do is London can continue, New York can sweep it, and then continue off, right? So on the higher time frames, Asia tends to be a little bit of a retracement because it's out of all the 3 sessions, London, New York, and Asia. Asia is always the quietest. Just the way it is. So Asia tends to be a little bit of a retracement on the higher time frame. But what that means is, let me just remove this. What that means is, let's say you've been bullish overall in London, New York, you can expect a bit of a retracement going, let's say, in Asia, right? And then for London, it will continue the trend overall. But what that means for us is we're going to look for our liquidity sweep. Now, if you just zoom out, and on the 5 minute chart, this will be a lot more obvious, but like I've just taught you guys on the 1 minute chart because it's just easier, isn't it? So here we go. And here's your liquidity sweep, right? Here's our liquidity sweep. And you can just tell, right? I mean, you can always tell by looking at price action when you get these little wicks like that, right? See these wicks here? You see how price just wicks up, takes out stop loss order, moves down, retracement up, and then like that, right? That's what we want to see. So what we have is we have our liquidity sweep like this. What we want to wait for, let's make this a lot, what we want to wait for is our fair value gap, right? We want to wait for our fair value gap to form. Now, this is really important. This is really important. Let me make this even more bigger. Right. So right here is our fair value gap. Right. This is our fair value gap, like this. Now, price has filled part of the fair value gap. Right. It's filled part of the fair value gap like that. That means that this right here is the remaining fair value gap. I'm going to fill that in properly. This right here is the remaining fair value gap. Right. That's our remaining fair value gap that we can enter. Now, for loads of you who are very eagle-eyed, you might, and I don't want to talk about this, I almost never talk about this. You guys might recognize this is an inversion fair value gap, right? This right here is an inversion fair value gap, which is a fair value gap that's been disrespected, and then it almost acts as the opposite direction. So this would have been a bullish fair value gap where price would have tapped it and moved off like that, right? That's what a bullish fair value gap would have done. But because price has broken the fair value gap, right? This fair value gap this bullish one almost becomes the bearish one like that, right? Now, I don't want to talk about that because I've almost never talked about inversion fair value gap, just because I want to keep it very simple. If you could spot that, congratulations, you know a lot about trading. But that's why we have this, I guess, almost partial fill of the fair value gap. It's because there's an inversion fair value gap there. All you guys need to know, all you really do need to know, is that, let me just remove this. What you do need to know is that there's a decent amount of this fair value gap still left, right? So it's very likely our price is going to come and then fill it up, right? If you have, and this is what some people get confused about. If you have, like, let's say this was our little fair value gap, right? Let's say price had wicked all the way up here and there's a tiny little gap. Ignore it, right? Ignore it. Price isn't going to do that. But because the fair value gap is still fairly big, because it's still fairly wide, we want to enter on that fair value gap, like that, right? So that's what we're going to do for our entry. If you guys really you wanted to forget fair value gap, and you could just take the order block, which would be the last up close candle before the down move. But for our entry, in this case, I'm just going to give you the fair value gap. And I hope it's really obvious that the entry pattern is the least important thing. Right? I hope that's very obvious. The entry pattern is the least important thing. Once you've got the liquidity, and once you've got the logic of each session, and even an indicator will do. As long as you've got the liquidity sweep, even an indicator will do. So what you're going to do is zoom out there. What you're going to do is you're going to put your stop loss at the liquidity sweep high. You just zoom out. This is the liquidity sweep high. You put our stop loss there. We're going to target, let's say a minimum 2 risk to reward ratio or a 3 risk to reward ratio. Now, you can, especially if you're in the 1 minute, you can target, a high risk to reward ratio. But I just honestly, if you can get a 3 risk to reward ratio at 50% of the time, you can become a millionaire. You can actually become a millionaire. So, and pass any prop firm and make all the money in the world. So complete, make 10K, 100K a month, whatever you want to make. So you don't need an insane win rate or an insane risk to reward ratio. You just need consistency, consistent bread and butter setup. But yeah, and let me just give you guys more examples, right? So because I know this fair value gap might confuse a lot of you. And don't be confused about the entry. I don't want you guys to understand everything in this video and then be like, oh, what's an inversion fair value gap? Because you really don't need to know it. I'm always in two minds about keeping that in the video just because, but I know some of you understand what that is. For me, personally, this is my entry after years of trading, of being like an ICT chart student. What I would do, and like I said before, Fibonacci, let me just make this clear. Licks the optimal trade entry, which is a Fibonacci retracement, the easiest entry pattern in all of trading, right? Like that. No guesswork. I don't have to guess what fair value gap am I taking. Hey, the fair value gap partially filled. This order block's got a doji candle. Should I put my entry on the body or the wicks? None of that, right? Every single time it's the exact same thing. Stop loss always at liquidity sweep high or low, and then my take profit always a 3 risk to reward ratio, like that, right? Well, you guys, there you go. Right, nice and easy. Set up my limit orders. Once I get tagged in, I'm more of a one and done sort of guy. I let you close the charts and move on with my life. I let price do its thing, right? More often than not, you'll be right. And if you're making 3 times your money, let's say you're making 1K, you're making 3K per trade, you'll make a stupid amount of money. You'll make a stupid amount of money. But that's my entry pattern. And let's say you don't want the fair value gap and you don't like the optimal trade entry, what you can do. And this actually, let me explain this because so many people I say so many people, a few people were asking me, hey, for the optimal trade entry, what high or low do I look for? You want to look at the most obvious highs and lows in price action, right? What's the most obvious, clear highs and lows? So I'll just go through the charts right now because I don't really want to make a separate video on it because it's a bit of a niche topic. So right here is an obvious low, right? Let me just mark this out. This is an obvious low. This is an obvious high. See this high here, right? Obvious low, obvious high. Obvious low, obvious high. Obvious low, obvious high. Obvious low, obvious high, right? Obvious low, obvious high. Obvious low. And then this right here would be maybe sort of an, iffy, maybe obvious high. I wouldn't really consider this a low. This is a very obvious high like that, right? So that's what I would do. Now, let me just make this clear. Some people might think that, is this a high? Is this a low? Is this got liquidity at it? Honestly, if you just focus on the major highs and major lows, and when you're in doubt, let's say you're in doubt, let me just clear this off. You're like, is this a low? What about this? Or this here? If you're in doubt, just focus on the most obvious ones, the most obvious lows, the most obvious highs, right? Make it clear, make it obvious. If you're in doubt, do not trade it. Just ignore it. So I hope that helps, because I know a few people are messaging me about, hey, I'm struggling about what high and what low to put on. So for the optimal trade entry, you wouldn't put it on this high here, right? You'd put it on this obvious low and this obvious high, right? If you wanted this to be your optimal trade entry, which you shouldn't have, because you should have entered on the liquidity sweep, but your optimal trade entry would be at this high and at this low. It wouldn't be at this high and it'd be at this high and this low, right? I hope that makes sense. Okay, so for the last bit of this video, right, because I know some of you will get confused with the fair value gap, some of you will get confused with optimal trade entry. The last entry pattern, which I would always recommend, is just take the order block, right? Now, the order block is the last up close candle before the down move when you're bearish. So there's videos on the channel about order blocks, so don't worry about that. What you're going to do, enter on the order block, put your stop loss at the liquidity sweep high, like that, right? Like that. And then, right here, right, you're going to target, minimum 3 risk to reward ratio, in my opinion. You can target this low, right? Literally equal lows here. You could do that. And like I said, I wouldn't target an insane risk to reward ratio like that, right? Especially not these lows. You don't need an 8 to 1. You really don't need an 8 risk to reward ratio to be a profitable trader. And all you really need is a 3 risk to reward ratio. But that right there could be your entry, right? If you don't like fair value gap, you're confused about what fair value gap to take. If you don't know what high or what low to put Fibonacci on, just take the order block. The last up close candle, pull it down move. And those 3 entry patterns are the 3 easiest entry patterns in all of trading. Optimal trade entry, which is a Fibonacci retracement, fair value gap, and order block. Now, each and every single one of them will make you money as long as you wait for a liquidity sweep and you get the direction of the market right. So if you listen to this video and you understand each session, you can make money. Now, what I would say on years of trading is just pick one session and master it. Right? For me, it was London. For you, it might be New York, it could be Asia, whatever session it is. Pick one and master it, right? Master it, understand it, know how it moves. You can have, 2 or 3 pairs. So let's say for gold in Asia, because Asia is fairly quiet, I would trade gold and let's say GBP JPY and maybe dollar yen or AUD USD. Right? One of those pairs be quite good, right? And you'll see this entry pattern at least in one currency every single day, right? So there'll be a currency that will have this entry pattern every single day in Asia, in New York, in London. All you got to do is find it. That's all you need to do as a trader.
So if you want to fix your trading psychology, you're going to have to fix your mind, right? Now, your mind is going to be represented by this circle here, and it's divided into 2 parts, right? You've got the conscious part of your mind and the subconscious part of your mind. Now, the conscious part of your mind, this is the logical part of your mind, right? This does all the thinking. This stores all your knowledge about trading, liquidity, ICT, indicators, daily bias. All of that is within the conscious part of your mind, right? And then the second part of your mind is the subconscious mind, right? This is the emotional mind. This stores all your emotion, right? Your FOMO, fear, greed, discipline, all of that is within your subconscious mind, right? So your mind is divided into 2 parts. Now you might be wondering, why am I telling you this? And it's for this simple reason right here, which changed my life, right? 95% of your actions come from the subconscious mind, right? Comes from the subconscious mind, not the conscious mind. So what that means, and bear with me here because this is so important. 95% of your actions come from the subconscious mind. And if you remember, your subconscious mind is the emotional part of your mind. It doesn't have any of the logic. It doesn't have any of your knowledge of liquidity, of ICT, of indicators. It doesn't have any of that. All it has is emotion, right? So 95% of your actions come from the subconscious mind. So it doesn't matter how much you know about liquidity, daily bias, ICT. If you can't fix your subconscious mind, you're never going to make money. And this is what happened to me. Within 2 years of trading, I had mastered technical analysis. I knew everything about liquidity. I could predict price on almost any asset, and I couldn't make money. I could not make money for 2 years. I understood trading, and for 2 extra years, I didn't make a single penny from trading. In fact, I lost so much money, and it was so just demoralizing and humiliating because I knew so much and I couldn't make money. And I was a laughing stock, bro. I was a laughing stock from all my mates because I was the most wise, knowledgeable, broke guy you'd ever met. And I don't want that for you because it took 2 more years of me having a model that worked but not making money, all because of my subconscious mind, right? And your subconscious mind has all of your emotions, FOMO, fear, and greed. And whatever is the dominant thought in your mind, whatever's the most dominant thing in your mind, comes and gets expressed through your body, right? Now, what that means is, let's say, because 95% of your actions come from the subconscious mind, if your overall, mindset is, I'm afraid to get into trades, or, I'm greedy, I can't, whenever price comes to my take profit, I just have to move my take profit because, I'm not satisfied with enough, or you over leverage. That is the most dominant thought in your mind, right? And what happens there is that gets expressed in your body, and that will control your actions, right? And then that controls your results or P&L. So what that means is, let's say you're afraid, like I was, right? For years, I was afraid to lose. Like, for whatever reason, I could win trades fine, but whenever I lost, I was so scared to get into a trade. Like, I was scared to get into a trade. As soon as I saw any sort of drawdown or, price reversing against me, I'd panic, I'd close my position, I'd move my stop to break even. And what was actually going on is deep within my subconscious mind was this fear. And I don't know, it could come from childhood, past trauma, it doesn't really matter. All we know is that it's there, right? This fear, right, was in deep with my subconscious mind. And if you remember, 95% of your actions come from the subconscious mind. So my body and my actions would always be someone afraid to lose, right? So I was afraid to even get into trade. I'd see my setup and I wouldn't even take it because I was so afraid. And then what that meant was I'd missed so many winning trades, and, my results were I made no money. Now, if you've watched my channel for a long time, you'll know I'm big into solutions. How do we actually fix this, right? What is the solution? Now, I'm going to save you 4 years of pain, and there's one simple solution that you can do. And it's an affirmation. Now, an affirmation is something that you say and that you write down repeatedly over time. Now, it might sound absolutely insane, this, but like I said, check out the comments. People are doing this and it actually works. This is what made me a profitable trader within 3 weeks. And what you're going to do is you're going to write this down. You're going to write this down. I am so happy and grateful now that I am a profitable trader. Let me spell this right. Now that I am a profitable trader. And you're going to do that, and you're going to do that repeatedly over and over and over again, right? And this isn't some woo-woo BS that I've made up. This is exactly what I do on a day-to-day basis. In fact, what my notepad right here, I don't know if you can see that, right here, full A4 notepad of just writing the same thing over and over and over again. Now you might be asking, why do we do that? Why do we say the exact same thing and write the exact same thing over and over and over again? Now, the reason we do that is because the way you communicate to your subconscious mind is either two things. It's repetition and emotion, right? Repetition and emotion. Now, I'm not going to get, because I want this video to be short, because I know so many of you need help with trading psychology, but for whatever reason, you hate watching long videos on psychology. So I'm going to keep this really short. All you need to know is that in order to get something into your subconscious mind, which determines 95% of your actions, is we need repetition and emotion. So if you say this over and over and over and over again, over time, it gets into your subconscious mind. And once it's in your subconscious mind that you are a profitable trader, which is our desired result, the FOMO goes, the fear goes, the greed goes, because you can't have two ideas, thoughts in your subconscious mind that contradict each other, right? So if you're a profitable trader and you're afraid to lose, those two things don't make sense, right? They don't make sense. Now, eventually, the stronger one is always in control, right? So right now, or at least for me when I was unprofitable, me being afraid to lose was way stronger than me being a profitable trader. But I kept saying this over and over and over again. What happens is this idea of me becoming a profitable trader gets bigger and bigger and bigger. And this, idea of me being a losing trader gets smaller and smaller and smaller. Eventually, you being a profitable trader comes ahead of being a losing trader. And then you being an unprofitable trader just goes. It literally just eliminates overnight. And that's when people say, oh, I was trading for 3 years and it clicked within 3 weeks. This is exactly what they're talking about, whether they understand it or not. This is exactly what they're talking about, because in your subconscious mind, you can't believe that you are unprofitable and keep saying this over and over again, right? Eventually, something's going to give. And before you know it, your actions are a profitable trader. And if you act like a profitable trader, you think like one, you feel like one, you will become one, and it will show in your P&L.